the committee. The gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Well, thank you, Madam Chair, and thank you for having this hearing. If Democrats are looking to crack the code on the inflation equation, I would suggest a little self-reflection. Today's hearing title shows Democrats want to blame high prices on everything. Corporate greed, broken supply chains, even the COVID-19 virus. But here's where it gets rich. They've left out the one thing that economists of all political stripes have pointed to as a leading cause of record price increases: the massive injection of federal spending that occurred over the past year. The Biden administration's American Rescue Plan plowed nearly $2 trillion into an already strong economy. This caused consumer prices to rise more rapidly than the economy's productive capacity. This is basic economics. Widespread, out-of-control inflation is the natural consequence of dumping unnecessary cash into an economy already well into recovery from pandemic disruptions. And now my constituents and yours are paying the full price for all that free money. By the end of last year, the expenses for many working families exceeded their incomes despite any wage gains. The outlook, at least in the short run, doesn't look any better. Until we have an honest conversation about the root cause of inflation, we're not going to get anywhere. My colleagues across the aisle want to talk about so-called corporate profiteering, so let's talk about that. Profit is not synonymous with greed. You don't have to take my word for it. Former Democrat Treasury Secretary Larry Summers and Jason Furman, a top economist in the Obama administration, have been openly critical of the attempts to blame corporations for inflation. According to Summers, quote, "Business bashing is terrible economics and not very good politics." I agree. Businesses have certain fixed operational costs, just like we do at home, and things that make the cost of running a business more expensive, like taxes and regulation. Those things get included in the final prices customers have to pay. So as wages remain stagnant, American families are finding it harder and harder to keep up. You hear it around the kitchen table across the country. Housing costs, more. Food costs, more. Even baby formula, if you can find it, because we have a national crisis around the shortage of baby food, is more expensive. So that leads me to the next so-called cause of inflation my Democrat colleagues talk about, my friend just talked about: supply chain bottlenecks. Steve Ratner, who served as counselor to the Treasury Secretary in the Obama administration, noted that, quote, "Blaming inflation on supply lines is like complaining about your sweater keeping you too warm after you've already added several logs to the fireplace. The bulk of our supply problems are the product of an overstimulated economy, not the cause of it," end quote. In short, Democrats' reckless fiscal agenda fueled a spending spree right at the moment our supply logistics were under the most strain. Supply issues are a product of excessive demand that happens by default after a huge government cash dump, like the American Rescue Plan. And then there are the billions of dollars in new regulatory burdens and the ongoing impact of Democrats' mainstream shutdowns during the pandemic. The Small Business Committee, led by our friend and colleague, Congressman Lukemeyer, or the Republican leader of the committee was Congressman Lukemeyer, calculated the Biden administration has produced 283 new regulatory rules, and on the way for more, with an estimated cost to businesses of $201 billion. The private sector has been forced to jump through hoops to meet local, state, and federal regulations in their attempt to solve supply chain issues, thereby raising the cost of doing business and raising the cost of things for the consumer. Meanwhile, the previous administration's incredible efforts to cut duplicative, overburdensome regulation and support private sector endeavors have been scrapped out of political expediency or out of a political agenda. It's time to stop chasing what feels good politically and do what's right economically. We must restore fiscal discipline and promote policies that support energy independence and long-term economic prosperity. Until we do that, Democrats will keep throwing flimsy excuses at the wall to see what sticks politically. And Americans are, quite frankly, tired of cleaning up the mess. With that, thank you, Madam Chair, for holding this hearing. Thank you for allowing us to discuss this important subject matter. I yield back.
Thank you, Ranking Member McHenry. I want to welcome today's witnesses. First, we have Mr. Damon Drummer, who is the Managing Director for Equitable Economy at Policy Link. Next, we have Mr. Rakeen Mahmood, who is the Chief Economist and Managing Director of Policy with the Groundwork Collaborative. Next, we have Mr. Sandeep Vaheesan, who is the Legal Director with the Open Markets Institute. Next, we have Dr. Mark Zandi, the Chief Economist of Moody's Analytics. Last, we have Mr. Tyler Goodspeed, who is the Kleinhaus Fellow at the Hoover Institution. Without objection, your written statements will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to see a timer that will indicate how much time you have left. I would ask you to be mindful of the timer and quickly wrap up your testimony when your time has expired. Mr. Drummer, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, and members of the committee for the opportunity to offer testimony on inflation and its impact on the 100 million economically insecure Americans. My name is Damon Drummer, and I am a managing director at PolicyLink, a national research and action institute that works to ensure all people in America participate in a just society, live in a healthy community of opportunity, and prosper in an equitable economy. I would like to center my discussion of inflation on the nearly 100 million people in America living below 200% of the federal poverty threshold. The impact of higher prices falls disproportionately on the 100 million who must pay an even greater share of their income to meet their basic needs. But if we look closer, we see that inflation is not the problem it is being made out to be, especially for the 100 million. The problem is an economy that suppresses wages and siphons wealth away from working people. In the time that remains, I will offer some perspectives on why the way we talk about inflation is simply wrong. Next, I will discuss how inflation pales in comparison to the broader affordability crisis afflicting the 100 million. I will conclude with policy recommendations that can begin to bring balance to our economy. So now about inflation. The way we talk about inflation blames our government for price increases, but it is disingenuous to lay inflation solely or even primarily at the feet of federal stimulus. There are many more factors at play, including the fragility of global supply chains, etc. Yes, our government stimulated demand. That was the point. It was absolutely necessary during the pandemic. The question is, who actually raised the prices? It was the companies choosing to take advantage of the pricing power that comes when buyers demand more goods than the companies have available to sell. These price increases were neither automatic nor inevitable. They were a conscious choice that disproportionately harmed the 100 million people in America living in or near poverty. To be sure, there are exogenous factors that inform how companies set their price levels. War and weather can inform the price of inputs. However, if we are not clear that it is not government spending directly, but corporate pricing power that drives inflation, then we will always hesitate to make the necessary public investments to build a more sustainable and equitable economy in which the 100 million can truly prosper. This is the work of our time. An entrenched program of economic policy designed to suppress wages and siphon wealth is a much bigger threat than inflation. Here are the numbers. Nearly 100 million people live in households with incomes of less than 200% of the federal poverty threshold. That's 1/3 of the US population. Households below the federal poverty line spend 18% of their income on energy, nearly 10 times the energy burden of higher income households. While productivity grew by nearly 60% over the last 4 decades, a typical worker's pay increased by less than 16%. Productivity grew 4 times faster than wages. In housing, between 2001 and 2020, home production in the US fell short of demand by 5.5 million units. The twin forces of a housing shortage and uneven wage growth have converged to create a national crisis that was only further exacerbated by the economic impact of the pandemic. Before the pandemic, half of all renters in America were paying more than they could afford on housing, half. In 2021, rents increased by at least 10% in 149 metropolitan areas. Today, 6 million renter households are currently behind on rent. That's double the pre-pandemic baseline. During the pandemic, meanwhile, the net worth of US billionaires grew by $2.1 trillion, an increase of 70%. The solution we recommend is to enact a bold program of expansionary economic policy that does the following: support wage growth for the lowest income workers, expand the labor force, ensure the benefits of productivity gains are shared equitably, invest in affordable housing infrastructure, support alternative pathways to homeownership, accelerate adoption of low-cost renewable energy, and promote the development of high-wage sustainable industries. This is our moment to enact practical policies and make public investments that will bring balance to our economy and deliver real results for the American people, especially the 100 million who are economically insecure. Thank you again for the opportunity to testify before you. It has been an honor.
Thank you, Mr. Drummer. Dr. Mahmood, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, thank you for inviting me to testify today. My name is Rakeen Mahmood, and I'm the Chief Economist and Managing Director of Policy and Research at the Groundwork Collaborative. Groundwork is an economic policy think tank dedicated to advancing a coherent economic worldview that produces broadly shared prosperity and abundance for all. My testimony today will focus on 3 key points. First, corporate profiteering is playing an important role in rising prices. Corporate executives and shareholders are enjoying the highest profit margins in 70 years, and consumers are paying the price. Second, Wall Street's presence in every corner of our economy suggests that a profit-price spiral is a significant risk. In contrast, there is no evidence that wages are driving prices up. Finally, today's price increases are the direct result of the outsized power that mega corporations hold over our supply chains and our economy more broadly. There are a range of factors driving inflation right now, including increased and shifting demand, as well as supply chain disruptions and the resulting shortages. However, the 70-year record high corporate profit margins demonstrates that mega corporations are taking advantage of this crisis to pad their profits, accelerating price hikes for consumers. Groundwork has combed through hundreds of earnings calls to understand why profit margins are at a record high. In these calls, executives tell investors about the last quarter's performance and discuss what investors can expect going forward. Over and over, the message from corporate America is clear. CEOs are telling their investors that the current inflationary environment has created significant opportunities to extract more from consumers by raising prices and pocketing the extra profits. Take Constellation Brands, the parent company of popular beers Modelo and Corona. On its earnings call in January, Constellation's CFO said, quote, "As you know, we have a consumer set that skews a bit more Hispanic than some of our competitors. And in times of economic downturn, they tend to get hit a little bit harder and they recover a little bit slower. So we want to make sure we're not leaving any pricing on the table. We want to take as much as we can." Mega corporations are able to get away with this kind of aggressive and extractive pricing precisely because of the current inflationary environment. As Hostess's CEO said in an earnings call this month, quote, we're also seeing consumers experience a lot of disruptions. They're losing benefits. They're moving to a normalized COVID environment. They haven't fully recognized they were absorbing pricing. And inflation is a helpful cover for these price hikes. The same CEO said, quote, "Pricing by definition is a change model. It's temporary. Consumers get used to it. When all prices goes up, it helps." Wall Street's influence in every corner of our economy makes this period of inflation unique and puts us at risk for a profit-price spiral. As profits rise as a result of price hikes, so too does the investor demand for those profits, sending prices spiraling upwards. Take Walmart and Target, whose executives wanted to pursue a strategy of increasing market share by keeping prices low. As a result, both companies experienced brutal sell-offs. Simply put, investors weren't having it. Having seen how successful price hikes were across the retail industry, they punished anyone who was not pursuing the same strategy. Within 3 months, both companies had raised their prices. While investor demands for higher profits are sending prices up, there is no evidence that wages are playing a role. A recent analysis by the Economic Policy Institute looks at the relationship between price increases and wage increases across sectors. They find no correlation between these two factors since December 2020. In other words, there's absolutely no evidence to suggest that wage increases for workers are to blame for the price increases we are seeing today. Corporate America's ruthless pursuit of efficiency has contributed to today's high prices in two important ways. First, it hollowed out and nearly eliminated diversity in our supply chain, leaving us without any fail-safes to withstand significant shifts in demand without supply shortages. Second, it has left us vulnerable to profiteering and price gouging. Without competition to undercut companies who are charging excess prices or laws and regulations prohibiting this behavior, companies will continue unabated. Congress must do its part to bring down prices by taxing excess profits to encourage productive investment and encouraging rigorous competition in key product markets and along the supply chain. It is also imperative that Congress makes long overdue investments in our supply chain infrastructure and in sectors like housing, healthcare, and childcare that have been putting strain on family budgets for decades. Importantly, interest rate hikes, which slow inflation by tamping down demand and making people poorer, will do nothing to make our markets more competitive, nothing to help spur overdue investments in housing and infrastructure, and nothing to address profiteering. We should no longer delay the important work of reorienting our economy towards the people who keep it going: consumers, workers, and small businesses. Thank you, and I look forward to your questions.
Thank you, Dr. Mahbood. Mr. Vahishan, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, and the other members of the committee for this opportunity to participate in the hearing. My name is Sandeep Vahisan. I'm the
Directly
legal
into
director
your microphone. Thank you.
at the Open Markets Institute, an anti-monopoly research and advocacy group that works to build a fair economy. Ongoing inflation in the United States is in part a story of corporate pricing power. In industries ranging from agricultural chemicals and seeds to mattresses to rental cars to restaurants, CEOs and CFOs have boasted that they've been able to raise prices and boost profit margins. The extraordinary pricing power of corporations in many sectors was not inevitable. It is a result of policy choices, most notably initiated by President Reagan's administration in the 1980s, that effectively reinterpreted and neutered the strong antitrust law that Congress had enacted against corporate mergers. As the Supreme Court recognized in 1966, Congress decided to clamp down with vigor on mergers and arrest a trend toward concentration in its incipiency before that trend developed to the point that a market was left in the grip of a few big companies. The Reagan administration ignored this policy judgment of Congress and substituted its own pro-merger judgment that granted extraordinary power on executives and investment bankers to roll up markets through consolidation. As two scholars wrote in 1988, the Reagan administration's policy statements and dearth of anti-merger enforcement served as an invitation to corporate America to merge with anyone. Every subsequent administration up through President Trump's followed the Reagan administration's permissive approach to merger enforcement. Indeed, they've often further loosened restrictions on merger activity on the assumption that mergers produce efficiencies and benefit consumers. Democratic and Republican administrations permitted consolidation despite the lack of evidence to support the twin assumptions that mergers resulted in efficiency and that powerful corporations willingly shared any of the benefits of efficiency with the public. If anything, the great bulk of evidence pointed in the opposite direction. As business school professor Melissa Schilling wrote, a considerable body of research concludes that most mergers do not create value for anyone, except perhaps the investment bankers who negotiated the deal. With the green light for consolidation, corporations have engaged in hundreds of thousands of mergers over the past 4 decades. Lax merger policies produce high levels of concentration in many markets. In such concentrated markets, corporations have more power to raise prices unilaterally and collude with rivals. For example, in meatpacking, processors appear to have used their individual and collective power to raise beef and chicken prices to consumers. Critically, inflation has given executives cover to exercise pricing power, which at other times might provoke strong reactions from customers and the public. A CFO of a supplier to food companies told the Wall Street Journal, "Widespread inflation makes it easier to broach the topic of raising prices with customers." A permissive posture on mergers has also had deleterious effects on the productive capacity of the United States. Corporations often eliminate quote-unquote redundant capacity following mergers, especially those involving competitors. Consider the effects of hospital consolidation on healthcare capacity. In metropolitan areas and counties across the country, hospitals in the past few decades have gone on a merger frenzy, concentrating local healthcare markets and obtaining extraordinary power over patients and payers. They've also closed hospitals and clinics that they deemed superfluous. Due in part to consolidation, the United States had 1.5 million hospital beds in 1975, but only 900,000 beds in 2017. even though the population of the country had increased by more than 100 million during that time period. As a result, the nation was much less equipped to respond to the pandemic and the surge in Americans needing hospital care. Further, in many instances, corporations have opted to grow through mergers and acquisitions instead of the more socially beneficial method of investment and hiring. Two economists captured this cost of lax merger policy, writing, "Billions of dollars spent on shuffling ownership shares are at the same time billions of dollars not spent on productivity-enhancing plant, equipment, and research and development. The millions of dollars absorbed in legal fees and investment banking commissions are at the same time millions of dollars not plowed directly into the nation's industrial base. The opportunity costs of merger mania are real, and they bode ill for the reindustrialization of America." The net result of permissive anti-merger policy is an economy in which many corporations wield exceptional pricing power and have less slack capacity to meet even modest increases in demand for goods and services. These are not the only political economic harms of corporate consolidation and concentration, which include lower wages for workers, but just the one relevant to today's hearing. The pandemic has merely exposed the underlying structural problems in the American economy. Thank you for the invitation to testify and participate in today's hearing. I look forward to your questions.
Thank you, Mr. Van Heesen. Dr. Zandi, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters and Ranking Member McHenry and the rest of the committee for the opportunity to speak and participate in today's important hearing on inflation. My name is Mark Zandi. I am the Chief Economist of Moody's Analytics, but the views I express today are my own. I'm also on the board of directors of MGIC, one of the nation's largest mortgage insurers, and I'm the lead director of Reinvestment Fund. Reinvestment Fund is a national CDFI that makes investments in underserved communities across the country. We're headquartered in Philadelphia. That's my hometown. I would like to make 3 points in my oral remarks. Point number one, clearly Americans are feeling the acute financial pain of higher inflation for the first time in 2 generations, and they're rightly unhappy. The typical American household makes less than $70,000 a year, but the acceleration in inflation over the past year is costing an additional $3,300 a year to buy the same goods and services that they were a year ago. That's $275 a month in additional costs. Just to put that into some kind of context, the typical household spends about $200 a month on eating out, about $150 a month on their cell phones, and about $100 a month on clothes. Obviously, this is very frustrating, and it is undermining sentiment. Nothing is more disconcerting and debilitating than inflation on consumer, business, and investor psychology. And this is I think at this point, a significant threat to the economic recovery. And the fate of the recovery does hinge on whether inflation will moderate meaningfully in the near future. Point number two, the high inflation, the painfully high inflation has been, in my view, a number of causes, obviously. But at the top of the list is the pandemic. That has badly disrupted global supply chains, particularly the Delta wave of the variant that hit last fall, which was a big surprise after the vaccines that we received in the spring. Badly disrupted, the pandemic has badly disrupted the labor market and demand supply dynamics in lots of markets, including, most importantly, perhaps the energy market. And that gets us to Russia's invasion of Ukraine, which is obviously top of mind here and is causing oil prices and other commodity prices to spike. And that's exacerbating the high inflation already. I mean, just to give you a sense of that, the increase in gasoline prices since the invasion began has added about $50 to the typical gasoline bill per month. So it just gives you a clear sense of how much damage that is. Now, I do expect the pandemic to fade, and as the pandemic fades, what I mean by that is each new wave of the virus will be less disruptive than the previous one. And I do expect that the severe disruptions to supplies related to Russia, Ukraine will be short-lived in terms of weeks, not months. And if that's the case, I do expect that inflation will begin to moderate, but clearly a lot of risk around that. And if the pandemic continues to intensify, if the Russian invasion of Ukraine is more disruptive, than I expect, and oil prices and other commodity prices stay more elevated for longer and begin to infect inflation expectations. And the Federal Reserve has a Hobson's choice, really no good choice. It will have to raise interest rates more aggressively, and recession risks will rise very, very quickly. This is still, a low probability scenario, but it's a rising one and increasingly more uncomfortable. Finally, point number 3, some blame the high inflation on government's fiscal policies during the pandemic that have shored up the finances of pandemic-stricken households, particularly lower middle-income households. I view that as a misdiagnosis of the problem. And they also call for government to stand down, and I think that would be a mistake. In my view, the policies put forward in the pandemic through the American Rescue Plan, beginning with the CARES Act, but through the American Rescue Plan, were critical to the economic recovery and ensuring that the economy got back as quickly as it did to close to full employment. And we'll be there if everything sticks roughly to script by the end of the year, which is quite an achievement. And now that the economy is back to full employment, I think it is very important for lawmakers to focus on how to addressing the rising cost of living, child care, elder care, health care, educational services. And I will call out the cost of housing. I think this is a critical element to high inflation going forward. All of us own or rent a home, and rent costs are rising very rapidly and will continue to do so. And lawmakers can help in this regard. So with that, I'll stop and turn it back to you. I do want to thank you again for the opportunity to participate in today's hearing. Thank you.
Thank you very much, Dr. Santi. Mr. Goodspeed, you are now recognized. Dr. Goodspeed, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, members of the committee, for the opportunity to testify today on an issue of utmost importance and concern to the U.S. economy and U.S. households. We have in the past year observed inflation at levels that we simply haven't observed since the end of the great inflation of the late 1960s to the early 1980s. And that inflationary pressure is no longer isolated to a few sectors. In fact, if we look at all of the measures of core or underlying inflation to which those who doubted that there was an inflation problem 10 months ago pointed, those measures are actually now indicating an inflation problem as bad or worse than that implied by the headline numbers. Now, I submit to the committee that the primary cause of the inflationary pressure that we are observing cannot be one that is global in nature, supply chains, pandemic-related labor market disruptions, corporate profit-seeking, because the increase in U.S. inflation has been so much greater than that observed in other advanced and major economies. In fact, of 46 advanced and major economies tracked by the Organization for Economic Cooperation and Development, the increase in average inflation in the United States in 2021 over 2019 was greater than in all but Brazil, Turkey, and the Kingdom of Saudi Arabia. And when we look at the timing of that divergence in U.S. inflation, it points unambiguously to March 2021. In the 12 months through February 2021, inflation in the United States and the euro area have been roughly the same, 1% versus 1.1%. Beginning, however, in March 2021, we see a big divergence such that by the end of 2021, the increase in the rate of inflation in the United States was approximately 3 times that in the euro area. And if we extend that series to January 2022, it increases to about 5 times. What happened in the United States in March 2021 that didn't happen elsewhere? We had a fiscal expansion, a fiscal stimulus that was the largest during an economic expansion in post-war U.S. history, equal to approximately 10% of the U.S. economy. This consisted predominantly of demand stimulus through transfer payments to households, with the immediate effect that demand for goods in the month of March increased 10.7% month over month, or about 240% at an annualized rate. A stimulus of this magnitude likely raised aggregate demand in the United States to a level 5% above its pre-pandemic potential output. But that is not all of the story, because pre-pandemic estimates of the potential output of the U.S. economy are almost certainly overestimates of the potential of the U.S. economy in 2021, because in the interim, we had 1.5 million estimated early retirements. We still had, in March 2021, 3.7 million Americans reporting that they didn't look for work in the past month because of the pandemic. We still had, by my estimations, a cumulative shortfall in business fixed investment of $1.8 trillion. Worse than that, in March 2021, the package passed likely exacerbated those existing supply-side problems by raising implicit marginal tax rates on the return to work. And following that, we had throughout 2021 the prospect of higher tax rates on corporate income after 2021. That was unlikely to incentivize increased business investment in 2021 because it raises the option value of deferring that investment into 2022. So we have a massive increase in demand, impaired supply. That difference has to go into prices. Now, we've heard a lot about supply chains and port capacity. I have to say that the volume of imports handled by U.S. ports in 2021 was about 20% above pre-pandemic levels. Our supply chains and our ports did a remarkable job handling and processing an unprecedented volume of goods shipments in 2021. Usually when we see quantity and price increasing, that means it's an increase in demand, not a decrease in supply. We have also heard a lot about market concentration and corporate power, to which I would ask the following questions. Why do we only observe this in 2021? Why only in the United States? If it's concentration in some sectors, why are we observing general price inflation rather than relative price inflation? And finally, why are we observing an increase in the inflation rate, and the inflation rate increasing at a faster and faster pace rather than a one-off increase in the price level? Thank you.
Thank you very much. I will now recognize myself for 5 minutes for questions. I would like to ask each of you to describe for me who will get hit the hardest if the Fed raises interest rates too quickly. How might this affect low-income workers, especially in communities of color, that are finally seeing employers offer bigger paychecks? And to just share with you, I'm a little bit surprised that everybody accepts increasing interest rates as a surefire way to contain inflation. I have questions about that, and I'd like to ask each of you to respond to the question about the interest rates. Thank you.
Thank you, Chairwoman Waters. You raise a very important point, An increase in the interest rate is going to relax demand for workers. That will put downward pressure on workers' wages. So what we're saying is we're going to manage inflation by lowering the wages of the lowest wage workers who are already being hit by the structure of our economy. It is unjust, it is inappropriate, and again, you're right. The interest rate increase is not a silver bullet. It's going to disproportionately harm the 100 million in our lowest earners in our economy.
Thank you. Mr. Zandi, would you please respond to the question of who will get hit the hardest if the Fed raises interest rates too quickly?
Thank you, Chairwoman Waters, for the question. I think the key thing for low middle-income households is to avoid recession, because if we go into recession, meaning the loss of jobs, higher unemployment, lower middle-income households would be hit much harder than higher-income households. So that's the critical thing here. And to ensure that the economy continues to expand and avoid recession, I do think it's important to begin to normalize interest rates. Interest rates are at zero, or effectively zero currently, and the economy is strong. We are creating 500,000 jobs every month. We've been doing that for over a year, in large part because of the fiscal policies. Unemployment is falling very rapidly across all demographic groups. And we are approaching full employment, so we do need to raise interest rates, normalize rates to ensure that the economy doesn't actually overheat and go into recession. It's, calibration, it's difficult. It's a difficult needle to thread, but I think at this point, we need some normalization rates in the near term to ensure that the economy does not overheat and avoid that recession, which would be very hard on low middle income households.
Thank you very much. I'd like to ask another one of our witnesses about this particular question. Mr. Rakeem?
Yes, thank you, Chairwoman Waters. I mean, interest
I'm
rates
sorry,
hike.
I want to make sure, Dr. Rakeem Mabood. Thank you.
Thank you. Interest rate hikes slow inflation by tamping down demand and functionally making people poorer. It does so by raising unemployment rates, by slowing down wage growth, and that's simply not the policy that we want to pursue right now, especially when we consider the plight of low-income people and communities of color who have been hit particularly hard by this period of inflation. The good news is that Congress has a lot of room to take on sort of the underlying conditions that are driving prices up, but Fed policy is really not the right tool right now.
Thank you very much. At this point, I will yield to the ranking member, Dr. McHenry, for 5 minutes.
Dr. McHenry, I thank you, Madam Chair. Thank you, Madam Chair.
Everybody's doctor.
Dr. Goodspeed, thank you for being here. Thank you for testimony. I think you said it very well. In what I said in my opener is that Democrats blame everything but their own fiscal policy for the inflation we're seeing. So that's fine. Let's just accept that. That's fine. So their explanation is corporate greed. What's your response?
Thank you, Ranking Member McHenry, Dr. McHenry.
Ha.
So my response is, as I noted in my opening remarks, if the causal explanation is corporate profit seeking, why do we only observe this emerging in 2021? Why do we observe this emerging only in the United States when market concentration by some measures has been rising globally? If it is a matter of concentration, market concentration, why are we observing a general increase in the price level rather than relative price increases in more concentrated sectors?
So along those lines, has there been an industry segment where you see collusion that has been driving up the price of goods?
Not that I have observed, and when I look at the correlation between measures of market concentration and observed increases in the consumer price index in 2021, I see a negligible correlation.
Okay, so there's not evidence of significant consolidation in calendar year 20 or 21 that would indicate something different than pre-pandemic.
Not that I've seen.
Okay, so so much for that scapegoat. So record prices get down to this general principle that we understand, which is too much money chasing too few things. And is that what's happening here?
Fundamentally, I think that is what is happening. And actually, when we look at the pattern of the increases in demand for goods specifically in 2021, as I said, we had month over month a 10.7% increase in demand for goods in March 2021. That was 240% annualized increase. Goods consumption had been already about 7% above trend heading into March. It then surged to 19% above trend and ended 2021 at 22% above trend. As I said, our supply chains did a remarkable job handling that excess demand. I would not place the blame at the supply chains.
Okay, so the supply chains are then a representation of the underlying economic fact, right? So that would be, that's not the prime mover here. It's a secondary effect of the economic policy?
I would say it is predominantly a symptom rather than a cause.
Symptom rather than cause. Okay, so then are we in a unique position compared to the rest of the world? How do we compare with the Europeans? COVID hit mainland Europe in a significant way, just like it did in the United States. How do we fare against the Europeans and over the last year?
Right, so as I noted in my opening remarks, the increase in the rate of inflation in the United States relative to the Euro area was about 3 times greater. If we try and extend the harmonized series into 2022, that rises to 5 times greater. As you noted, we were all exposed to some of the same global shocks in 2021. In the United States, in 2021, the magnitude of the increase in the demand stimulus was just orders of magnitude greater than in the rest of the advanced economy world. And at the same time, we engaged in active measures that further impaired some of those supply-side constraints.
Okay, so bad economics have driven this inflation question. Democrats control the House, the Senate, and the White House. They had a $2 trillion bill to juice the economy at the very time the economy was ripe to open, and that's why we've exacerbated the problems. You raised this question. You stated this. Their actions, the Democrat policy actions of last year, raised the implicit tax rate on returning to work. What does that mean? Simplify that for me. What does that mean for the average person? What do they experience as a result of these policies?
What that means is that when you have things like the extension of supplemental federal unemployment insurance benefits into September, that's a year and a half into the economic recovery, when you effectively eliminate work requirements for an expanded child tax credit, that lowers the rate of return on work relative to not working.
And therefore, we have a hangover effect from those bad policies.
That likely slowed the recovery in labor force participation in the United States in 2021.
Bad policy, bad economics, bad outcomes. I yield back.
Thank you. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Inflation has been a worldwide problem since COVID. It's maybe a third larger here in the United States than in most of the developed world. We had a lot of fiscal stimulus. We should remember that most of it was bipartisan. Most of it was signed into law by President Trump. Yes, there is one bill for $2 trillion, the rescue bill, that was Democratic. There was also a $2 trillion tax cut bill that was exclusively Republican during the Trump administration. So both parties have been solely responsible for $2 trillion in fiscal stimulus. We kept people's incomes high during a COVID pandemic, but we closed down the bars, the restaurants, all the entertainment. People had money, they couldn't spend it having fun at restaurants and bars. They went to Amazon. The ports in Los Angeles, as one of the witnesses pointed out, 20% increase at all-time volume, and of course there were delays. When it comes, those delays have led to more inflation. We have passed, pretty much with Democratic votes, an infrastructure bill. If we had passed it 5 years ago, we wouldn't have had the delays, particularly in the ports in Los Angeles. We've had many hearings in this committee on the cost of housing. And clearly, local governmental decisions raise the cost of creating new, particularly apartment rental units. We are told, I believe by Mr. Zandi, that this inflation is costing the average American family $275 a month. Keep in mind that under the American Rescue Plan, families were getting $250 per child, $300 if the child was under 5 years old. So we insulated parents up until our failure to pass the BBB bill. We've passed a competitions bill to make sure that more of the chips are built here. Autos are a huge a part of the inflation. I believe 1/3 is caused by auto costs, and that's a chip shortage. I've talked about ports, and finally, I'd like to talk about oil. Keep in mind that Democratic policies for conservation have virtually doubled miles per gallon. Imagine what the cost would be worldwide per barrel if Americans were still driving the kind of car I was driving when I got my first car, 9 miles a gallon. We have alternative energy, we have efficiency. Oil production in the United States is higher today than it was when Biden took office. We're stated for 2023 will be the all-time record in U.S. oil production. Mr. Zandi, what is the worldwide elasticity in the demand for oil? Will we see either here or in other countries people using less oil because it is so expensive? And I'll point out that I think might be more elasticity of demand in other countries than here in the United States.
Yeah, the elasticity of demand, price elasticity of demand for oil is low compared to other products and services, obviously
Yes.
because it's a necessity, people need to get to work. But to give you a sense of it, before the Russian invasion of Ukraine and the run-up in oil prices, oil was trading about $75 a barrel. We expect that global demand for oil this year to be about 6 million barrels a day. Just for context, there's 100 million barrels a day of demand, roughly. Now, with prices, let's say they average, closer to $100 a barrel. Now, obviously they're a lot higher today, given all the things that are going on. But for the year, they average $100 a barrel, and hopefully it's no more than that. Then global demand will be something like 5.5 million barrels a day. So that gives you kind of a sense of the price elasticity of demand. That also reflects weaker global economic activity. So there is some impact on demand in the near term. There's more impact in the longer run because then people can change behavior and
people can
businesses
adjust.
change.
If I
But in the near term,
just
it's relatively small.
just point out that supplemental unemployment insurance ended in early September, and we have not seen a we've seen by its sunsetting that it was not having a major effect on the availability of labor and the number of people in the workforce. I'll yield back.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Dr. Goodspeed, the United States is experiencing, as we've all talked about here, time and time and time again, record high inflation that is broad-based and hitting the wallets of my constituents in Missouri's 2nd Congressional District. Current prices are at levels not seen in 40 years. It's not just the gas prices that are 40% higher, but meat, poultry, fish, they're all 12% higher. Overall groceries entirely are up 7%. You've discussed the negative impact that the American Rescue Plan and its multi-trillion-dollar spending spree had on inflation and consumer prices. But could you explain how the Build Back Better Act, which is discussed still widely in this committee, would spend, and it spends an additional $3.5 trillion, would impact our economy and rising inflation?
Well, thank you, Congresswoman. There are a number of provisions in the Build Back Better program that I believe would exacerbate some of the supply side challenges that we've talked about before. In particular, all of those new programs have income phase-outs, which means, as to use my previous term, they're going to raise implicit marginal tax rates on work as they phase out. And furthermore, insofar as this is deficit financed, that is likely going to put upward pressure on interest rates, which is going to make borrowing costs greater for American households and possibly necessitate further action on the part of the
So it doesn't pay for itself, does it, sir?
It certainly does not pay for itself.
Dr. Goodspeed, I know that, per usual, our colleagues across the aisle want to blame big corporations for inflation, particularly energy companies. But if we look back at history, it is global crises centered around energy that have driven up energy prices. Just look at the 1973 oil shortages. In 1979, the Iran hostage crisis. In 1990, it was the Persian Gulf War. And now, it is the Biden administration's refusal to reinstate America's energy independence by drilling in ANWR, opening up the Keystone Pipeline, ending the federal freeze on all new oil and gas projects, fast-track the pending LNG export permits, to just name a few. Dr. Goodspeed, How has the Biden administration's energy policies, or lack thereof, allowing us energy independence, impacted the prices Americans are paying in terms of gas, electricity, heating oil for their homes?
To put some perspective and quantitative perspective on this issue, at the Council of Economic Advisors, we estimated that the lower cost of energy in the United States, thanks to the shale revolution, was saving the average American household $2,500 per year on the eve of the COVID pandemic. And insofar as actions such as those you just described limit the output potential of the U.S. energy sector, that is likely to chip into that $2,500 per household. And sorry to be technical, but the elasticity of output in the United States with respect to the price of oil is about 0.02%, negative 0.02%. So that means a 10% increase in the price of oil is going to decrease U.S. output by about 0.2%. And I think what we've seen in the past few months is something quite a bit larger than 10%.
And how does a strong energy policy help our economy, meaning by lower prices and job security to protect our country?
Well, I think that we're seeing this today with the difficulty on the part of many European capitals in terms of responding aggressively to the Russian Federation. Having domestic production capacity in effect serves as insurance in the event that foreign supply becomes unavailable. And one thing that we've seen is that different sources of energy are not perfect substitutes in the event of a crisis, because we can't simply ship LNG to Germany in the event that Russian gas and oil becomes unavailable.
But boy, if we could, it'd be sure a lot cleaner than the LNG they're getting from Russia, wouldn't it, sir?
That is quite true.
Yeah, it sure would be. Well, we're going to hear from the President of the United States here shortly, or he may be on right now. And finally, I think he's going to agree with the vast majority of American people, and frankly the rest of the world, that we should not be importing Putin's oil into the United States of America. We have the ability to be energy independent on our own, and we don't need this butcher's blood on our hands. Hopefully we can open up our own energy independence, and with the drilling in Anwar, with the Keystone Pipeline, with the fracking, with the shale, all the things that you talked about to allow us to move forward energy independent on our own in a cleaner and greener way. So I thank you for your input, and I yield back.
Thank you.
Thank you. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you. Let me start with you, Mr. Drummer. You mentioned two things in your testimony that I've been fighting for ever since I've been in Congress, and they are, one, the need to raise wages for workers, and also removing structural barriers to employment that have locked many low-income Americans out of economic opportunities. So tell us, in your own words, how important is it for us in Congress to tackle these issues of income inequality and occupational segregation that we face today?
Thank you, Representative. It's absolutely fundamental for the 100 million who are economically insecure. Again, that is 1/3 of America. Just 48% of those are white people, 52% people of color. This is America. It is vitally important that we do everything we can to raise the floor of wages for the lowest earners. Again, I mentioned in the testimony that wages have stagnated for about 4 decades. Meanwhile, the productivity of workers has increased by fourfold, or rather increased fourfold faster than wages have increased. And the question is, why shouldn't the workers get the benefits of that increased productivity? Why should that increased productivity flow to the top earners and the top shareholders in our country. And so to restore balance in our economy, it is incumbent upon Congress to not just engage in expansionary fiscal policy, not just encourage and coach the Fed into doing expansionary monetary policy, but to have expansionary regulatory policy. We have to raise the floor. The minimum wage is lagging behind normal inflation for decades.
Right. Now, Dr. Zanti, let me go to you. This business going on in Russia and Ukraine right now has opened up so many areas that illustrate our nation's insufficiency, being so utterly dependent upon other nations for our energy and our growing need for food that I raised in our last meeting. And so, can you tell us whether or not we need to move to do things like opening up, revisiting the Keystone Pipeline, for example? The reason I'm saying that is it puts us, our nation, in a terrible position when we've got to depend on Russia for our oil, or Iran, Saudi Arabia, Venezuela, these socialistic countries, and several of whom are our worst enemies. So do you not feel that, or agree with the growing feeling among both Democrats and Republicans that we got plenty of oil right here? We've got plenty of resources here. Why do we have to depend upon Russia when it might make sense to revisit the Keystone Pipeline and other areas that we're blessed with the natural resources here? And I'd like for you to comment on that and give us your opinion.
Well, thank you for that, Congressman. I think we are energy independent. We produce 10 million barrels of oil a day. We consume 10 million barrels of oil a day. We do import some Russian oil just because of the economics of it, but we export oil and petroleum products as well. So the net of all that is we are energy independent. In terms of natural gas, similarly, we produce a lot of natural gas already. Natural gas prices remain low here because that's more of a local market. The problem with oil and oil prices is it's a global market. And so the issue is, what's going on overseas. And Russia is a big producer. And if you take they produce 10 million barrels of oil a day, they export 5 million. They're the second largest exporter in the world. So if you take that offline, which, completely understandable given the situation and what's going on in Ukraine, I very much get it. But it's going to be difficult to adjust to that. So I think we are there. And, we need to shepherd our resources, and we need to make sure that we can provide those resources in a cost-efficient way. Evaluating pipelines and other things are important. But at this point, I think we've done a pretty good job in terms of energy independence.
Thank you,
Thank you
Doctor.
very much. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chairman. And Dr. Goodspeed, being an old ag econ guy from Oklahoma State, I was very pleased to hear you discuss the unique concept of the inelasticity of demand, because that's really difficult for a lot of people to get a grip on. The concept that you either have enough or you have too much, and that price dramatically shifts from one perspective to the other. But back to the core issue. The Fed's balance sheet sets at just under $9 trillion, more than double the pre-pandemic amount. The total U.S. public debt's increased nearly $7 trillion since late in January of 2020. Dr. Goodspeed, can you discuss how this drives inflation and overstimulates the economy from a macroeconomic perspective?
Certainly. Thank you, Congressman Lucas. So what we've observed in the past year is an almost unprecedented excess of demand over supply in the U.S. economy. and that has to a large extent been accommodated by the Federal Reserve. And if we look at a broad measure of the money supply in the United States, that has increased by about 40% since the start of the pandemic.
So as we would say in my town meetings, if you dramatically increase the amount of money chasing the same or fewer goods and services, then you drive up the price of the goods and services, correct?
That is correct.
Thank you, Doc. Farmers across the country are experiencing higher costs for chemicals, seeds, fertilizer, equipment, fuel, labor, among other increased input costs. The squeeze and uncertainty felt by farmers and ranchers right now will be felt for years to come. This means higher food prices we see now may be with us for some time. Dr. Goodspeed, can you discuss how persistent inflation isn't simply a supply chain, logistics, or a pandemic recovery issue, but spreads much deeper into the economy?
That's right. Sometimes we see relative price increases where prices are increasing in one sector or another, but what we've seen in the past year is broad-based inflation that crosses multiple sectors, and it hurts working people very hard because they don't have the same bargaining power that other workers have. Things like rent, food, energy, utilities are much bigger shares of their disposable personal income, and many lower-income households don't have hedges against inflation, the principal of which is housing.
So the little guys, we would say in town meetings, don't have flexibility. They're locked into their situation on their income with their expenses ever increasing. This month, the national debt topped $30 trillion, and the Congressional Budget Office predicts that the debt-to-GDP ratio, I should say, will double over the next 30 years. Doctor, how troubling is this for the long-term, and I mean long-term, health of the U.S. economy?
Well, yes. In the short term, it means that every 25 basis point increase in interest rates is going to raise the cost of servicing that debt by $75 billion. In the long term, look, if we look over history, when the U.S. has had debt-to-GDP ratios of this level, the way we got out of it is not especially encouraging. Some of it was from growth, but we do not have those growth tailwinds that we had in the aftermath of 1945. A lot of the rest of it was inflation and what we call financial repression, which was basically capital controls and implicit pressure on banks to hold federal government debt. Those are not good recipes.
I started out farming, Doctor, in 1977 as we slid into the inflationary period of the Carter years, and we went through Mr. Volker's dramatic tightening of the money supply, and we saw the old 1930s interest rate caps come off. I borrowed cow feed money at 17% in 1981 and was so happy to get it, so happy to get it. But I also watched a generation of young farmers and ranchers who'd come home from the Vietnam War who were absolutely exposed economically be destroyed. And the last of those sheriff sales were still taking place in the 1980s. So I carry a few scars of watching my neighbors. We need to try to avoid that, don't we, Doctor?
I think that's right. And when one looks at past episodes of the Federal Reserve having to play catch up with inflation, they have to respond even more aggressively than had they responded earlier in order to wring that inflationary pressure out of all sectors. And that was what we saw in the early 1980s.
The longer the binge, the harder the hangover?
Yes.
Yield back.
Thank you. The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair, and I thank you for holding this hearing. I think it's exceedingly important. I was at the State of the Union, and I thought the President gave an excellent speech. I was very proud of him, to be very honest with you. And one of the things that he said that really caught my attention was that capitalism without competition is exploitation. Capitalism without competition is exploitation. My question to you, Mr. Zandi, is who suffers most from the exploitation when you don't have the competition in the capitalistic society?
Well, I think competition is a key element, Congressman, of a well-functioning capitalist system. Without that competition, we don't have innovation, we don't have entrepreneurs, and we don't have growth. And clearly, we'll struggle with higher prices and inflation. So, it's a vital ingredient to a well-functioning economy.
And when we talk about persons within the society, how would minority people be impacted as a result of this? We know that minority unemployment, especially Black unemployment, is usually about twice that of white unemployment. So if you don't have the competition in the capitalistic society, by the way, I'm a capitalist, if you don't have that competition, does it have a greater impact on African Americans?
Yeah, I think that's fair to say. I mean, if competition is impaired, it will result in higher prices for the goods and services produced by that business in that industry that is uncompetitive. And, for lower middle income households who don't have savings, who don't have wealth, who really are struggling just to pay their bills paycheck to paycheck, that becomes an incredibly difficult hardship. Hard choices have to be made very quickly here. And that's obviously what's happening right now with inflation as high as it is. People are having to make difficult, tough decisions about what they're spending their money on because, if I have to spend more to fill my gasoline tank, I'm going to have less to spend on everything else. So it is critical that we ensure that markets are competitive, that businesses are offering prices that are consistent with that competition, because if they don't, low middle income households, African Americans, Hispanic groups will be hurt more.
Thank you. Mr. Drummer, would you care to weigh in on this, please?
I mean, yes, it's, if you're talking about the structure of our economy in general, it is incumbent upon this committee to, again, as I said in testimony, it's about expansion. We are nowhere near the peak of what America can do. We're nowhere near the top of our productive capacity. And so any claim that any investment into our economy will inherently be inflationary is just flawed.
Let me come back to you again, Mrs. Andy. I always enjoy conversing with you. Your commentary is excellent. Let's talk for just a moment about indexing. There is a belief that we should index wages to possibly the CPI or even to the poverty, such that if you work full time, you don't live below the poverty line by indexing. Give me your thoughts on indexing, please, and you've got about a minute to do it. Sorry about that.
No worries, and thank you for the kind words. I would not be a fan of that, Congressman. I think we had experience with that back in the 70s and 80s, the last time we suffered very high inflation. And the indexing, the so-called cost of living adjustments built into contracts, exacerbated the wage price dynamics and ultimately resulted in a very severe recession that hurt all Americans, particularly lower middle income Americans. I think it's much better to focus policy on trying to address the wage inequities and make sure that we provide the resources necessary so that people can get better jobs and get better pay. Obviously, this is hackneyed but very true. Education and training and helping with childcare and elder care, things that allow people to go to work and get the skills that they need to get higher wages and to do better. And I think that would result in a better, well-functioning economy. The indexing, I think, would be difficult, and clearly, I'm not sure how lawmakers would be able to intervene or enter into that, given that's a decision by private businesses.
Thank you. My time has expired. Thank you, Madam Chair. You're back.
Thank you. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Dr. Goodspeed, as the title of this hearing suggests, my friends on the other side of the aisle want to blame higher prices on everything but their own policies. They blame it on supply chain bottlenecks. They blame it on COVID, and they even blame it on corporate greed. And I want to focus on that last narrative for a minute, corporate greed. Let me tell you how it works in the real world, and I'll give you an example from my own district where businesses are struggling with the cost of higher inflation. The Suffaletta family in Georgetown, Kentucky, have been in the retail home furnishings business since the late 1940s. In a conversation last week, they informed me that in the last 18 months, the cost of goods from their manufacturers have increased 30 to 40%, and they're still receiving price increase letters every week. They're also experiencing price increases on sold orders that have not even been produced yet, but they aren't going back to their customers asking for more money than what they agreed to at the time of placing those orders. That's an important point. They're not sitting around the table trying to figure out how to exploit their customers. They're struggling because their profit margins are down because the cost of their inputs are going up. Instead, the Suffletas are choosing to absorb those additional costs, contrary to what Mr. Drummond's narrative is. They're choosing to absorb them. And like most small businesses, their cost of labor and overhead have gone up over 25%. So now they're having to determine how to operate without passing all of those costs onto the end consumer and still have some profit at the end of the year. This idea of businesses trying to exploit this and profiteer is offensive to most small firms in America today. Now, Stephen Ratner, a former Obama Treasury official, summed it up perfectly. Blaming inflation on supply lines is like complaining about your sweater keeping you too warm after you've added several logs to the fireplace. The original sin was the $1.9 trillion American Rescue Plan passed in March. The bill, almost completely unfunded, sought to counter the effects of the pandemic by focusing on demand-side stimulus rather than on investment, and that has contributed materially to today's inflation levels. So, Dr. Goodspeed, you focused on the increase in aggregate demand, but I want you to elaborate on your testimony about how the American Rescue Plan also constrained the supply side. Specifically, talk about how the American Rescue Plan stifled the labor supply.
Well, thank you.
Which is contributing to the problem that the Suffleta family is having right now.
Well, thank you, Congressman. And to your observation about what you're hearing from businesses, we have over the past year seen the producer price index outpace by a considerable margin the consumer price index, which suggests or implies that firms have been taking that pressure out of margin rather than passing most of it on to prices. In terms of the supply side impacts that you mentioned, I've calculated that there has been a cumulative shortfall since the pandemic began in business investment of about $1.8 trillion. Throughout 2021, with the Build Back Better agenda, there was the prospect of substantially higher taxation on corporate income after 2021. That was unlikely to help facilitate a recovery in business investment.
So to the extent we have supply chain bottlenecks, part of that is because there has been less business investment.
That is correct.
Because of uncertainty of the potential of tax increases.
That is correct.
And then explain also how the American Rescue Plan discouraged labor supply.
And it discouraged labor supply in two ways. One, the expansion of the child tax credit as designed under the American Rescue Plan effectively eliminated work requirements. So relative to the 2017 expansion of the child tax credit, remember we doubled the child tax credit in 2017, relative to that expansion of the child tax credit, we actually lowered the return on work. And in addition to that, we extended the $300 per week supplemental federal unemployment insurance benefit, which likely lowered employment by about 1%.
So in addition to increasing aggregate demand and creating excess demand in the economy, the agenda from the administration constrained supply. Let's talk about another area of constrained supply coming from this administration. Is it more likely that oil executives are sitting around their board table trying to figure out how to stick it to their consumers? Or is it the administration canceling drilling leases, closing pipelines, or limiting production? Or is it uncertainty and unease among exploration and production companies that new environmental crackdown will come? Or is it the financial regulators that are attempting to limit access to capital, making it illogical to invest in new wells? Which is more likely?
I would say the unresponsiveness of supply in response to onerous regulation and crackdowns on domestic energy production, because if we look at the historical relationship between the price of West Texas Intermediate and rig counts, that relationship broke down in 2021.
Thanks. I yield back.
Thank you. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you very kindly, Madam Chair, and thank you for the hearing. And, I'd like to.
Does Mr. Cleaver have his microphone on?
It should be on.
Very faint. I
What
can barely
is it?
hear. It's his microphone is just very faint.
Probably need to use the pastor voice.
Is your microphone on, Mr. Cleaver?
Yes.
Now
Yes,
we can hear
I
you.
hope.
Thank you.
Okay. Yeah, the pastor's voice can't eliminate the need for the microphone. Let me concentrate, Dr. Drummer and Dr. Mabud. I don't know if either of you drink hint water. You know, it's advertised quite a bit on TV. Any of you drink? Either of you drink it? HINT, hint water.
No, sir.
Oh man, it's necessary. It's the best thing that's come along. I love the hint water. That you know, and it has a hint of peach, a hint of berry, whatever it is, but it's water. No calories, no nothing. It's water, and so I love it. And I also love it because I could go to the dollar store and get a hint at $1 a bottle, because at the dollar store, everything in there is $1. At least until about 3 weeks ago. And I guess in an attempt to avoid false advertising on the doors, they have something taped up and it says, all items are now $1.25. So the dollar store is now $1.25 store, which means that hint goes up from $1 to $1.25. I am not happy about that. You know, life is going downhill when hint is cost 25 cents more. So Dr. Drummond and Dr. Mabud, do you agree with Dr. Zandi that no matter what happens to pricing across most goods, that inflation will remain as high as long as the cost of housing continues to rise? The hint is going to continue, you know, it's not going to drop as long as housing continues to rise. You both or either of you agree with what Dr. Zandi has written?
Thank you, Representative. Based on her testimony, I would like to defer to Dr. Mabud.
Thank you. Thank you so much. I think the point that you're making is really critical, right? Which is that low-income communities, particularly low-income communities of color, are dependent on these essentials like housing and places to buy cheap goods like the dollar store. And so higher prices will inevitably disproportionately affect exactly those communities, especially when the prices are going up on essentials that people really need. You know, if you need diapers, you need diapers. It doesn't matter if the box is $20 a box or $40 a box. And we know that low-income communities are particularly likely to see rent as a bigger proportion of their budgets and see food and other essentials as a bigger proportion of their budgets. I think the other important thing to remember here is that these exact same workers and families are also more likely to face discrimination in the labor market because of occupational segregation and other barriers to entry into the labor market. So low-income folks, particularly low-income folks of color, are really hit from all sides by these price hikes, with rising prices at the checkout line and when they pay their rent, and harder time accessing good, well-paying jobs.
Thank you very much. So hint goes up. It's not going to, Dr. Zandi, you know, if you look at the cost of housing, the cost has increased a whopping 470%. 470%, and over the last 40 years, and so as long as that continues to rise, like it is Headwater going to come down?
Yeah, a good point. Yeah, we've got a very severe shortage of housing, particularly for affordable housing, both on the rental side and on the homeownership side. This has been developing really since the housing bust in the wake of the financial crisis. Vacancy rates across the housing stock are at record lows. So this has resulted in surging housing values and surging rents. And rents all in account for 1/3 of the consumer price index. So 1/3 of inflation, measured inflation, is housing. So as long as we have this shortage, as long as we don't address the supply shortage, and here's where lawmakers can be critically important, rents are going to grow quickly, house prices are going to grow quickly, and the cost of living is going to continue to rise quickly.
Thank you. The gentleman from
Thank you, Madam Chair.
You're welcome. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Madam Chair. Dr. Godspeed, I feel like I've seen this movie before. To paraphrase a classic, we appear to be rounding up the usual scapegoats for inflation. Under the heading Primary Causes of Recent Inflation Trends, the majority hearing memo lists supply chain bottlenecks and shortages, lack of housing supply, lack of competition. There's no mention of the majority's deficit spending and the monetization of those deficits to dramatically increase the money supply. Last week, Chair Powell agreed that inflation is a monetary phenomenon. The way we ended up with this inflation is that the government dramatically increased the deficit in the Rescue Act and other legislation, and the Federal Reserve provided the lending to support the deficits at no charge in interest rates. The primary cause of inflation is deficit spending financed by the Federal Reserve buying the debt and increasing the money supply. One price increase that stands out from the rest, and that is the skyrocketing increase in energy costs. It's been mentioned by almost everybody here today, especially the price of gasoline. Even before the Ukraine invasion, the price of unleaded regular was closing in on $4 a gallon. This is a steep relative price increase, and most analysts understand that this increase was a result of supply restrictions that followed on the administration's assault on the domestic energy production. Please give us your assessment of how reversing the administration's restrictions on domestic oil and gas would reduce gasoline prices, and how much would gas prices decline if we reset the clock to January 19th, 2021, and erase the administration's impact on the domestic energy sector. Could we expect to restore energy independence as we had before?
Well, thank you, Congressman. And I think, as you noted, we've heard some of these stories before. In fact, in the 1960s and 1970s, there were a lot of allegations that the price pressures that we were observing were the result of oligopolistic or monopolistic competition. And empirically, those claims were subsequently tested and rejected. I would expand upon a remark I made in response to questions from Congressman Barr, namely that if we look at the historical relationship between the price of West Texas Intermediate crude and oil rig counts in the United States, those two series typically tracked each other very closely, meaning the price of oil goes up, rig counts go up, we get more supply. That relationship completely broke down in 2021, and I think that was a result of the regulatory crackdown on domestic energy production and the looming prospect of more. Now, it's hard to say where domestic oil prices and gasoline prices would go in the coming months simply because of so much international geopolitical uncertainty.
Well, thank you. You know, one of the favorite boogeymen of our friends on the other side of the aisle is the evil price gouging firms. They're one of the usual scapegoats for unsound fiscal and monetary policy. I believe we can expect that businesses will respond to market forces, including inflation, like any other economic player. But it's more than a little naive to habitually resort to the price gouging monster to explain 7.5% inflation. Is there any solid, convincing, credible, and peer-reviewed evidence that businesses with disproportionate market power have been a major cause of inflation through price gouging?
I've seen no serious academic study to that effect, and I would add that most empirical studies, and for that matter, theoretical papers on this, suggest that in the short run, the pass-through from cost to price is actually lower in less competitive markets than in competitive markets. In the long run, competitive markets have lower average inflation rates, but in the short run, the pass-through is actually higher in competitive markets.
Well, thank you. And while I would believe the role of housing supply and inflation is far more subtle than the other side suggests, and listing it as a major cause of inflation, I do have serious concerns about the cost of building housing. And I believe that the cost of building new housing, whether single or multifamily, determines the prices of houses and rents at the margin of the market. Adding demand to a housing market in which the cost of a new housing is continually being pushed up by regulations and restrictions on innovative building techniques really serves mostly to just drive up even further the prices and rents of all housing. Do you agree that to make significant progress in providing affordable housing, we need to focus on bringing down the cost of building new housing?
Well, I would say that we should be focused on increasing the supply of housing generally, and we have a problem that it is very difficult to construct new housing in the United States. And we should ask ourselves, why did the price of housing go up so much in 2021? Well, let's remember that housing and autos are the two most interest rate sensitive sectors in the U.S. economy. Thank you.
Thank you. Thank you, Madam Chair.
Welcome. The gentleman from Illinois, Mr. Foster, who is also the chair of the task force on artificial intelligence, is now recognized for 5 minutes.
Thank you, Madam Chair. One of the recurrent themes on both sides of the aisle here has been inadequate business investment, and now we're being caught in a number of ways. And I'd like to explore the extent to which sort of the short-termism and the incentives that encourage short-termism in so much of our industry. We're seeing obviously underinvestment in resilient supply chains. That's kind of obvious in a number of areas. We've also seen, this policy. We've seen inadequate investment in inventory. For rainy days. For years, the best management procedures have been claimed to be this just-in-time delivery of everything with essentially no inventory of anything. And now as manufacturers are panicking and switching to sort of from just-in-time to just-in-case inventory policies, there's a tremendous short-term spike in demand and leads to tremendous market inefficiency. Throughout it's sort of reminiscent of the toilet paper shortage at the start of COVID, where as far as people could tell, there wasn't any increase in the rate of consumption of toilet paper, and yet there was a huge shortage because of a malfunction of the market that I think we're seeing in many areas. We're seeing also the same thing in computer chips, where companies like Intel engaged in more than $100 billion in stock buybacks, lost the lead in advanced semiconductors, and now are asking the federal taxpayer for a $50 billion bailout. Now, similar thing in the airlines, where during the Obama expansion, they made very high profits, but didn't leave enough resilience in their operations, and had to ask again for the $50 billion, essentially a gift from the government, from the federal taxpayer. Not a loan like TARP, but an actual just straight gift. And so, an obvious, there are a number of potential reasons for this underinvestment. But I was wondering, Mr. Drummer and Mr. Balt, could you say a little bit about how the CEO compensation structures might encourage this short-termism? Where keeping small inventories make you profitable this quarter, but leave you in trouble when the tide goes out. Mr. Drummer, do you want to?
This is a very good question, Representative, because it's not just a question of law and policy. It's about practices of some of the largest corporations. Yes, when CEOs are incentivized to make quarterly benchmark profits, they extract all the work they can from the lowest paid workers. Let's compare Walmart and Costco, right? Costco pays double what Walmart or Sam's Club pays, but they make 7 times more per employee than Sam's Club. And so the short-termism is cultural. And so, yes, we do need law and policy that forces and really pushes these companies to do the right thing, because it ought not be an option to treat your employees right.
Thank you, Congressman. raise a really important point. We've seen changes in law and policy over the past 40 years that have encouraged short-termism. So you noted CEO compensation that's tied to short-term movements in stock price. We've also had changes to antitrust policy and securities laws that have encouraged firms to engage in practices like stock buybacks and mergers and acquisitions in lieu of the more socially beneficial undertaking of investment and innovation. I think the chip industry nicely illustrates that point. It used to be the envy of the world, but now companies like Intel have been so focused on generating short-term cash flow that they've been leapfrogged by foreign rivals like TSMC and Samsung.
Would you like to go ahead? I'll take a risk here and see what, there's.
Sure.
Yeah,
I would say that one of the reasons that we had weak investment throughout much of the expansion from 2009 to 2016 was that the relative cost of capital in the United States was much higher. So the cost of domestic capital formation was quite considerably high. And that's why in the aftermath of tax reform in 2017, we actually saw the level of investment rise to about 10% above the pre-2017 expansion trend. And I think one of the reasons that we saw a weak recovery in investment in 2021 was because there was the prospect of higher corporate income taxation in 2022. That means that the value.
Okay, I understand. There's never a bad time to lower taxes, and no matter how much, what it does to the national debt. Let's see, in my 23 seconds left, Dr. Zandi, there's some things the Federal Reserve is clearly going to do, which is to unwind the balance sheet. Will that be stimulative or contractive in terms of the demand? That's a good thing? That will reduce or increase?
At this point, yeah, I think, Congressman, the Fed needs to normalize policy. That includes interest rates, short-term interest rates, allowing them to go off the zero lower bound. And at some point, not right away, we have to see how things go, but allow the balance sheet to start to wind down, which is what they did after the financial crisis, and I think that worked well. So at some point this year, that seems like a good policy to pursue. Again, you don't want the economy to overheat and then ultimately go into recession, because that hurts the very people that we want to help.
Yeah. So they're doing the right thing. Thank you, and I yield back.
I think so. Yeah, that'd be my view.
Thank you very much. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair. Dr. Goodspeed, right here. President Biden had one accomplishment last year, and that was the approximately 300 new regulations his administration issued on businesses and workers. The cost of these regulations total about $201 billion. That's their cost, by the way, that they said they had. This is 3 times the regulatory costs imposed by the Obama administration and 40 times the cost imposed by President Trump in their first year in office, respectively. My question, I guess, begins with how do these regulatory burdens impact inflation and the price of goods, their businesses' ability to hire workers, and their ability to have more resources to actually focus on their businesses?
Well, thank you, Congressman. These regulatory changes, at the end of the day, increase costs. They increase compliance costs. Compliance costs incur opportunity costs because workers working on compliance aren't working on other more productive activities. There's also a deadweight loss insofar as it prevents transactions that would otherwise have occurred. And there are also spillovers into unregulated industries. And I would just add that over the long run, an increased regulatory burden tends to decrease the flow of new firms into the market and decrease the exit of incumbent firms, so it lowers competition. So insofar as one's hypothesis is that insufficient competition was a cause for the inflation that we've observed, the regulatory burdens that we've seen increase in the past year likely exacerbated rather than attenuated that.
So you just sort of made the case that, I know the other side constantly talks about them doing things when you're concerned about the low and middle income folks, and yet they continue to produce legislation, more rules that do the very thing that they're talking about they want to try and minimize. As you just indicated, the hammer comes down on the low and moderate income end of the spectrum with inflation, with all sorts of rules, costs of rules and regulations. Is that not correct?
That is correct.
I also am the ranking member on small business, and we had economists come into our for a briefing the other day, and I asked him to break down inflation. And I said, basically, I think it's composed of excess money supply, rules and regulations, energy costs, and the supply chain / jobs problem. Would you agree that's kind of the four main drivers of our inflation we have today?
I would agree with that.
I asked him to break it down percentage-wise, and he said about 40% money supply, 20% regs, 20% energy, and 20% supply chain. Would that be in the ballpark, do you think? Or one of them a little bit low, one of them a bit high? What would you estimate?
I would lower the estimated probability for supply chains, and I would substitute for the regulatory costs. I would just say, generally speaking, it's excess demand relative to supply.
Okay. So, again, I sat down and we had the chairman of the Federal Reserve in here, Chairman Powell, last week. And I read this off to him, and he was talking about being able to manipulate the economy through interest rates and all sort of stuff. And I told him, I said, unless you're going to go with 10%, these type of costs, if you look at them, where do you in this group have that much influence? And so if you look at supply chain, look at energy production regulations, almost all of those are under the direct ability of the administration to impact those, is it not? Would you not say that?
It is.
And a lot of it is, quite frankly, without Congress even being able to intervene. I mean, the president, first week in office, first thing he did was close down the pipeline. I mean, he can open that back up. There we go. That fixes that 20%. Supply chain, he can help with some of the threats of taxation. He can help the people get back into the workforce. Rules and regulations, that's obviously falling all on him and his administration. And so then you come to money supply, and you look at, I'm guessing at 50-50, the Fed with the way they manipulated and 50%, but us, the Congress putting, those guys putting more money into the system. So it would look to me like the Fed will only have like 2.5% out of the 7.5%. At most, the administration can fix this thing, and to me, it all lies at their feet. Would that be a fair analogy?
I think that's a fair analogy. I would add that the two sectors over which the Fed has most control with respect to inflation is housing and auto prices, and we've seen some big increases there in the past year.
Very good. Just a quick question for you. Inflation going to go away, and do you think we have a recession coming shortly?
When I look at the underlying inflation measures, when I look at the change in inflation expectations, I think that this is going to be very persistent, and it's going to take some very aggressive action on the part of the Fed and hopefully Congress. And that's disconcerting because that could mean some economic pain.
Thank you very much, Doctor.
Thank you. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Madam Chair and Ranking Member. I appreciate this. It's interesting that when President Trump and the Republicans took office at the crest of the largest economic expansion in history, things were going well and they were very happy about that. Then, of course, he presided over the worst labor market in the modern U.S. history, as did the Republicans. And the reality was, it was the pandemic. I mean, the truth of the matter is, you can't blame all those millions of job losses on Donald Trump and some of the crazy things he would say. It was the pandemic. But here, it's interesting. The Republicans blame everything on everything except for the pandemic. I mean, it seems to me, Dr. Zandi, that you kind of nailed the thing down pretty well when you were talking about the pandemic. Am I wrong here? I mean, is a lot of the inflation due to the pandemic? I can't hear you. You're muted.
Yes, Congressman, you are precisely right. It is the pandemic. And, there's a long list of reasons for the high rates of inflation. At the very top is the supply disruptions created by the pandemic, particularly around the Delta wave. I mean, I'll give you a poster child example. Chip plants in Malaysia shut down last August and September. They couldn't produce chips for U.S. and German and Japanese vehicles. The F-150, the most popular vehicle in the United States, couldn't get the chips. They had to shut down. They couldn't produce. Inventories collapsed. Shortages. Prices have gone skyward. And roughly 1/3 of the acceleration in inflation that we've observed over the past year is simply related to that fact. That is directly related to supply chains. And I can give you other examples, but you are exactly right.
Yeah, it it seems to me, again, that I could be wrong about, but it just seems to me that that's the case. Again, otherwise we can say, well, those damn Republicans, they lost millions and millions of jobs. What's wrong with those guys? Their policies are so terrible. It was the pandemic. I mean, as it is the pandemic here, and that's why I think we should work together to figure this thing out instead of yelling at each other about these things. But
Can I point out, just because there's a lot of discussion around inflation overseas and why inflation overseas.
Of course.
What matters is the acceleration in inflation over the past year. And they are very comparable in every advanced economy, including in the United States. It's the increase in inflation. And if there's any differences, they're related to measurement differences. So precisely what is happening here is happening in Canada, in the UK, in Germany, all across the advanced world. So it's very, very similar and goes back to the point that this is the pandemic, because the pandemic has affected everyone equally.
Yeah, it's happened all over the world. I mean, that's the part that I didn't, it's a little bit like this, just to be frank. Reminds me of the old tobacco hearings. And you'd have a group come in and say, oh, no, those cigarettes are great. They're not unhealthy. Of course not. And then the other groups come in, no, of course they're not. They're not healthy. They cause cancer. I mean, the truth of the matter is here that we see inflation all over the world. We see these problems all over because of the pandemic, and that's the big deal here. And it seems like the Republicans want to place blame on somebody, and they want to place blame on the Democrats. They don't want to take a look at, well, really the blame is on the pandemic, and how do we work together? Now we've got the problem with Russia. How do we work together? The two big things that I see too are, housing and cars. Housing in particular. I mean, and we do have to figure that out. In California, the prices have gone out of sight, and I don't see them coming back until we get more supply. And there are things that we need to do. But anyway, that's what I'd like to say. I just wanted to say sometimes it's kind of nutty listening to this stuff because, again, it's not realistic.
Can I say, Congressman, on housing, what was in Build Back Better around tax credits, LIHTC for low-income housing, neighborhood home tax credit for fixing, rehabilitating old housing stock in dilapidated parts of urban centers, home housing trust fund. All of these things will go to quickly increase the supply of affordable housing and goes directly to this very strong surge in rent growth and house prices that we're observing right now. So there are things we can do, and that what's in Build Back Better goes a long way to in fact, doing that.
That's why I support it. My time is ended. Thank you.
The gentleman yields. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Chairman, thank you very much. To our colleagues who are watching this, please know that I think that there's an equal participation here today for us to tout. And I appreciate Mr. Vargas and his comments very much, my dear friend. I'd like to, if I can, please go back to a statement that I believe Mr. Drummer made, where he spoke directly about household incomes and how it's been flat. When in fact, if you go to the Bureau of Labor Statistics, you will see that household incomes rose 3 times higher under Reagan-Trump policies than under Obama-Biden. And that is because I believe that what is occurring in particular right now that we can directly relate to is that we have problems getting people to go to work. As of this morning, OPM is still weighing their decision-making on whether we are going to have federal workers go back to work. Well, I know what that's like because my office has been at work during this entire pandemic, and we simply attempted to work with each other. But OPM still has people what they call maximum telework. And if you have the federal government workers that are not reporting to work, if you have an administration that is continuing with their
onslaught at the free enterprise system, including workers of airlines, workers of transportation. How can people not go back to work when we have not encouraged it? We have to be leading edge people to say, as managers of our business, let's go back to work. If you've got a reasonable reason why not, then that flexibility should be given by OPM. But the way Republicans see it is that policy matters. In other words, elections matter. Policy matters, and that in that circumstance, when you give people more take-home pay, when prices are reduced, when gasoline at the pump is a good deal rather than a jab deal, that the free enterprise system really does really well by itself. Mr. Drummer made a good bit of comments, which I tend to want to agree with equitable prosperity. But that's what the free enterprise system is, and that's why under the policies of Republicans, I don't have to say Donald Trump, but Republicans and Donald Trump, more people worked than ever. More African Americans, more men, more women, more minorities, and people were at work. And if you go back to an old book from the Dallas Fed, The Myth of the Rich and Poor in America, the facts of the case are real simple. If you have a job, whether it be higher or lower pay, for 10 years, if you create a circumstance where you go to work, you will raise yourself from one segment, one, in essence, economic level to another. We need people back at work. We need our free enterprise system to work. We're a capitalist nation. Mr. Drummer, have I said anything that you want to help me with?
Thank you, Representative. You said many things that I want to help you with, and I would love to engage this conversation even beyond this hearing. So one, it's also a fact that wages have not kept up with productivity. And we have to examine what kind of economy allows a situation for workers to be more productive, but the wage growth is pretty flat. Not numerically flat, but it's extremely unimpressive, and for the last 40 years has been uncharacteristic in the course of the whole of American history. So we have to examine that. So two, if you wanted to respond, but two, also in terms of the point of people wanting to go back to work, we don't have a shortage of people who want to work. We have a shortage of good jobs, and that's the problem. When the pandemic era listen, we don't have a benefit cliff.
You know what? And I appreciate the gentleman. I've hauled hay, I've climbed poles, I've done a lot of things that I had to do to help myself out. And I'm sorry you don't think there aren't enough good jobs. We have
good paying jobs, Representative.
Well, as you know, I will just accept that as your answer. And I appreciate the time. And thank you, sir. And I yield back my time.
Gentleman yields. The gentlewoman from Ohio, Mrs. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I would also like to thank all of our witnesses for being here today, for providing testimony. I want to begin by acknowledging the pain and the frustration that Americans are feeling over this inflation. I don't think we can say stop. I've also said from the beginning of the pandemic that this is a global public health and economic crisis. And I know after 2 years of the shutdowns, of looking at supply chains and also the Omicron variant, this latest issue with inflation is the last thing that we want or that we need. Democrats in Congress and the Biden administration are committed to doing everything we can to deal with the inflation and its impact on the lives of American families. Mr. Drummond, let me thank you because I do concur with you in your last statement. Inflation has historically reinforced economic disparities among minorities and people in rural America. When inflation cost hits the average American, it hits harder for Americans who have already had economical challenges and been disadvantaged. Because for every dollar increase in inflation, this could equate to $5 for someone who is financially unstable. Can you speak to the inflationary challenges these Americans face, whether it's purchasing food for their families or buying gas for their daily commute? Can you talk about that briefly?
And we're in a bit of a quandary here, and I appreciate the question, Representative. The reality right now is that, yes, price increases disproportionately impact the household budgets of low-wage workers. That's a fact. But also, it's also a fact that a rate cut is going to do what? Depress demand for workers and do what? Take money out of the pockets of these very same people. And so if we care so much about low-income households, I don't think the rate cut is our silver bullet to fix that situation. What we have to do is take a step back, understand that inflation concerns is a red herring. There are larger structural problems that we have to address, and let's get to business and build this country and have an equitable economy where all can prosper and reach their full potential. And that's what we're here to talk about.
Well, let me go to my next question, and thank you. Dr. Mabode, I'm sure you are aware that the Federal Reserve Act mandates that the Federal Reserve must promote things like maximum employees, moderate long-term interest rates, and last but not least, stable prices. I don't want this to be a quiz game, but do you know how many governors that there are on the federal board? There's 7. And did you know there were 3 vacancies now? And I guess I'm concerned about the vacancies because my Republican colleagues have literally walked out and not appointed these things. And I think the American people need to know that we're doing everything to help during these tough times. So I guess, do you have any comments on how this? Some will say it doesn't affect inflation, but the reason for having 7 is to bring diverse people. Right now,
Mrs. Beatty, we've lost your audio.
What do you think about not filling those Federal Reserve spots? I think there's a reason that they're on there for us to hear all the differences as we look at the effect of inflation. Mr. Mabode, Dr. Mabode.
Thank you for that question. Simply put, I think now is not the time for political games. As Mr. Drummer laid out, families are in crisis. And so now it's really the time to have a full slate of folks at the Fed, and it's time for us to take these issues on. I do want to note that, the Fed has a dual mandate, right? It has the mandate to keep stable prices, but it also has the mandate to ensure full employment. And there are huge swaths of this country who have never experienced full employment. Even now, in the midst of what is arguably a historic recovery, the Black unemployment rate is still double that of the white unemployment rate. So I am really eager to see a Fed that is taking that full employment piece of their mandate seriously.
Okay, thank you, and I yield back.
The gentlewoman yields. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And in full disclosure, I'm a small business owner. I'm a defender of profits. Profits are good. Profits mean jobs. Now, I've been in the car business for over 50 years, and we are in one of the strangest markets I've ever seen. If I'd gone on TV 3 years ago, for example, and said, in a commercial, that if you buy a car today, it'll go up in value over the next 3 years. Well, if I would have said that, the FTC would have fined me for false advertising. But this is exactly what's happening in the industry today. We simply cannot get our hands on enough new cars to satisfy consumers' demands, and this in turn causes us to pay a very high premium to obtain used cars so we have any inventory to sell at all. If we don't have inventory, we won't be able to sell anything, and we couldn't maintain a payroll, in my case, of hundreds of employees. Now, to put this into perspective, how much has changed because of the pandemic, we used to carry 800 units on the ground, 800. And today I called my daughter, and I just checked in, and she says we have 20 on the ground. Now, corporate greed, we talk about corporate greed, but corporate greed has not caused us to carry 90% less in inventory. It is the result of strained supply chains, overspending, the threat of taxes, and minimum wage conversation. There is no mass conspiracy, I got news for everybody,
between every business in America to squeeze the consumers to raise their profits. That doesn't happen. Corporate greed is a buzzword. It's a buzzword from people who have never run a business. While the price for a good might be higher from week to week, it does not mean that profit margins are also proportionally increasing. If you are looking at gross sales dollars, you're looking at the wrong figures. If a $100 million company grows to a $200 million company, it is highly unlikely that the profit margins were also able to double, and it doesn't happen. So what should we be talking about is government greed, not corporate greed. We've seen many new regulations that are causing businesses to hire more compliance officers that are a net negative to their bottom line. We've heard many Democrats talking about companies paying their fair share, which means they see a profitable company as something that they can squeeze money from to fund their own pet projects. These public policy decisions are having a detrimental impact on prices since businesses are having to dedicate more resources to comply and respond. It isn't this fake notion of corporate greed for companies that struggled through the pandemic creating higher prices. It's government greed. So my question to you, Dr. Goodspeed, can you talk about the effects of higher taxes and more regulations on the price of consumer goods?
Certainly, Congressman, and if I may, I would like first, just as a point of fact for the record, I would like to point out that when I say that that inflation in the United States has risen by more than in other advanced economies, I mean that on the eve of the American Rescue Plan, inflation in the Euro area and in the United States was 1%. The increase in that inflation rate, using a harmonized measure of consumer price inflation so that we're comparing apples to apples, the increase in that inflation rate in the United States has been 3 times that in the Euro area. In terms of taxes and regulation, I think that there are both supply and demand side factors here. In terms of price pressures, one of the things about the tax measures in 2017 is that it incentivized higher labor force participation and it incentivized greater investment in domestic capital formation. That tends to increase the productive capacity of the United States economy, which lowers inflationary pressure.
And creates competing wages.
And creates competing wages. And to put numbers on that, during the first 3 years of the preceding administration, real wages, inflation-adjusted wages, grew 9.8% for the bottom 10th of the wage distribution. They grew 4.8% for the top 10% of the wage distribution. Real wealth inequality declined, real income inequality declined, and labor share of income rose during the 3 years through 2019.
Yeah, if you reduce regulations, you reduce taxes, you let Main Street compete, competition drives everything everybody's saying about corporate greed. People get an even shot at rising and making good for their life.
Correct. And that is why we observed in 2019, 1 year alone, the median American household experienced real inflation-adjusted income gains of $4,400. That was more in 1 year than in the preceding 16 years combined.
Okay, thank you, and I yield my time back.
Gentleman yields. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Okay, thank you, Mr. Chairman, and I welcome all of the members to the committee. One of the things that I wanted to have y'all elaborate on is when Chairman Powell addressed the committee maybe about a week ago, he said when the Fed seeks to bring inflation down, they raise interest rates, which put the restraints raising overall borrowing costs for households, businesses, and consumers. If that is the case, which I think they probably know more about it than I do, what happens in inflation when interest rates are raised on housing and on cars and everything else that you can think of, but the average consumer carries more credit card debt with higher interest rates than the interest rates that is going to probably be decided on by the Feds? How do you stabilize the interest rate that are being charged on credit card debt during this inflationary period as compared to trying to get the economy stable, because they're going to increase more and more debt with interest rate that exceeds sometimes 30%. Would anyone care to talk about it on the panel?
Yes, Representative.
Well, I'll take a crack at it, Congressman. I think that there are a number of different channels through which higher interest rates will affect the economy. And you mentioned one, through higher interest expense for households, particularly those that have debts, and most specifically credit card debt, home equity lines of credit. But it works through other ways as well. One of the fastest and quickest and most significant ways through lowering asset prices. So one of the reasons why stock prices are down, obviously there's many reasons, including Russia's invasion of Ukraine and higher oil prices, is the investors now discounting a normalization of interest rates. And so that's brought down stock prices. Now, of course, that hurts high-income Americans and high net worth Americans. So all Americans are going to feel the financial result of these higher interest rates. But we do need to see, as the economy comes into full employment, as unemployment gets close to 3%, we do need to see the rates of growth in the labor market and the economy more broadly kind of get back to a level that's consistent with the growth in the labor force. And we need that moderation to occur. So zero interest rates, which is where we are today, isn't consistent with that outlook for where we're headed. So we do need to see interest rates normalize, and all Americans, from top to bottom, are going to feel it. But obviously, middle Americans would desperately need to avoid going back into recession. And if we don't normalize rates, slow the economy as we come into full employment, the odds of that are going to rise, and we're going to hurt the very same people we want to help.
Okay. And I'm going to try to get in another question before my time run out. The administration put forth a lot of funding for small and mid-sized poultry processing to assist with the processing capacity. Do you think we need to take the same approach for the timber industry and invest in small and mid-sized timber processors? We know there have been a lot of processing issues with timber. Would it be beneficial to the housing supply market to invest in smaller processors to help increase the timber supply would help housing? And that's for the whole panel.
I can't, thank you, Congressman. I can't necessarily speak to the timber industry specifically, but what I can say is that it would certainly be good tax policy to expand the expensing for investment in new plant and equipment in the United States. That would include equipment of all sorts. And as I noted in some of my earlier remarks, one of the issues with the prospect of higher corporate income tax rates down the road is that it raises the incentive for firms, including firms in the timber industry, to defer investment in new equipment to 2022 because a deduction for new equipment investment is much more valuable under a 28% rate than a 21%. So that was unlikely to help equipment investment recover in 2021.
Can I just push back on that, Congressman? I don't think there's any material evidence that the lower tax rates that were put into place back in 2017 have impacted investment in any meaningful way. And I don't think the discussion and debate around higher normalizing and rolling back some of those tax cuts had any impact on business investments over the last year. In fact, I would say if we go look at business investment in equipment, it is much higher than it would have been without the pandemic. It has gone skyward, and that goes to supply chains, that goes to trying to improve productivity growth. So I don't think there's any, the timber industry is a problem, but I don't think the solution is lower tax rates.
Okay, with that, Mr. Chairman, I yield back.
Gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
Well, thank you, Mr. Chairman. I'm almost speechless. Not entirely. I've got plenty to say, but that we're here doing this because obviously some of my colleagues haven't learned anything from history, especially recent history. I heard in testimony earlier, well, we expect the inflation to be short-lived. We'll get out of it soon. Well, yeah, if you really buy into a lot of what we heard here today, that it's the big corporations that are the problem and it's not the self-imposed destructive policies that have brought us to where we are right now. Let's turn the clock back just a few months ago, where in the first quarter of last year, we heard, oh, there is no inflation. It's not really there. It's just temporary, caused by the pandemic. We'll be out of it really soon. But many of us on this side of the aisle, me included, were saying no, in the direction that we're going with this wasteful spending, that it's not just the deficit spending that we're in, it's where we're spending the money. You're dumping money into the demand side and then regulating the supply side. It's going to cause problems, and we've seen that. Then it went into, well, it's here, inflation is here, but it's not going to last long. Then we get into, well, finally, you're recognizing that we're in inflation, but we got to find somebody to blame it on because it can't be our bad policies. Well, quite frankly, my colleagues on the other side are, again, turning away from fact and embracing a more advantageous political science instead of real science, and scrambling to find a scapegoat for self-created problems that are affecting Americans across the board. And it's not just me that's saying this. Former Democrat Treasury Secretary Larry Summers warned last year that excessive fiscal stimulus will cause the highest inflation in generations. Democrats dismissed these warnings, but it turned out he was right. Again, this is somebody from the other side of the aisle. And Federal Reserve Chairman Powell, last week, in responding to one of my questions, he admitted that the reckless stimulus spending is a significant driver of inflation. These are facts. Even the Washington Post has reported that Democrat pollsters recently advised the White House to find a villain to blame inflation on. This is the Washington Post, because Republicans' criticism that the out-of-control spending as the cause of inflation is being effective. So even the Washington Post is reporting that pollsters, political science, not natural science, is driving this entire narrative. Just a little while ago, President Biden finally announced that we were going to stop importing Russian oil. But then he continued on to blame U.S. oil producers as the reason that we're not producing oil, not his executive orders. And I also would suggest let's look at some of the self-imposed policies, like the influence ESG has had on American producers by punishing investors and steering them away from fossil fuels and investing in petroleum companies in the U.S., but not in foreign entities. So there is a lot of blame to go around in a lot of areas that we have self-imposed the problems that most Americans are facing today. So the Democrats are now blaming the so-called greedy corporations for their self-created inflation problems. This is baseless and completely unserious argument. This is simply to distract us from the real problem that they have brought upon this nation. And American people are, quite frankly, not buying it. Polling shows that 70% of Americans disapprove of the way this administration is handling inflation. It's because they're doing the same thing over again, expecting a different outcome, and I'm not even sure they're expecting a different outcome. They're just hoping that the American people will finally buy into the narrative they're pushing out there, but they're not. In a piece titled "The White House Once Again Offers a Bizarre Message on Inflation," the left-wing Washington Post editorial board said President Biden is facing mounting criticism for inflation's rise to its highest level since 1982, which is right after the end of the Carter administration. And I suggest if you go back and look at history, we're repeating the Carter administration's years all over again, but on steroids. Unfortunately, the White House's latest response is to blame greedy business, and economists across the political spectrum are rightly calling out the White House for this foolishness. I can go through a litany of things that have caused this problem, but I'm running out of time. So, Mr. Goodspeed, in your testimony, you said the American Rescue Plan artificially increased demand as much as 5% above pre-pandemic forecasts. Can you explain briefly how that is the case?
Thank you, Congressman. Briefly, that means that with a fiscal stimulus of that magnitude, it increased aggregate demand in the United States economy at the same, relative to the potential output of the U.S. economy. That 5% is probably an underestimate because, as I noted in my testimony, the supply side potential of the United States economy was probably depressed in 2021.
All right, Mr. Chairman, I yield back.
The gentlewoman from Iowa, Ms. Axney, who is also the vice chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Chairman, and thank you to the witnesses for being here. I think we all know how much price increases are in the minds of our constituents as we're talking here in Congress, and the war in Ukraine has far more severe consequences for their people than higher gas prices. But since we're here to talk about inflation, let's focus on that to start. Right now, gas prices are up 55 cents nationally in the last week, following oil prices higher after the invasion, of course. Those prices may rise further now that we're blocking imports of Russian oil, and I support that move. But since Russian imports make up only 3% of our consumption, that's not all that's going on here. Even before this invasion, gas prices were up about $1 over last year, and oil was trading at $90 a barrel. Now, Dr. Zandi, good to see you. Do you have an estimate of the price where U.S. shale oil production becomes profitable?
That price is somewhere between $65 and $70 per barrel. You know, obviously, I'm painting with a broad brush. There's big differences across the fracking fields of North America. But that is the marginal cost of production and transporting that oil to the global marketplace, so about $65, $70 a barrel.
Thank you. Okay, so at about $65 to $70 a barrel, it's becoming profitable. And again, oil was trading at $90 a barrel at last we talked. So pre-pandemic oil was around $60 a barrel, and domestic production here was around 13 million barrels a day. Since the pandemic, though, production is down 10%. So that's about 1.3 million barrels a day. Now, I understand companies can't turn this on overnight, but oil has been over $60 for a year now. Dr. Mahbood, do you have any explanation why production is still so far below where it was?
Thank you for that question. I mean, the fossil fuel industry is not immune to the type of profiteering that I spoke about in my testimony. And this moment when things are in flux, when there's a lot of geopolitical factors happening, is an opportunity to exploit those headlines in chaos and use their grip on the market to raise prices. You know, just 5 oil and gas companies raked in over $75 billion in profits last year, which was the highest increase in profits in 7 years. Look, the only thing more lucrative than pandemic profiteering is war profiteering. And sadly, we're probably now going to be seeing both. And major oil companies, including household names like ExxonMobil, Shell, Chevron, are set to return record buybacks to their shareholders in 2022. Analysts are estimating that these buybacks could range anywhere between $38 and $41 billion, which is nearly double the buybacks in 2014, which is the last time that oil traded above $100 a barrel. So this is just corporate profiteering. This sector is not immune to that.
Well, it's incredibly unfortunate. I certainly hear a lot of calls lately for increased U.S. production directed right here at Washington, D.C., but the truth is we're not the ones that are stopping it from happening. The companies are just choosing not to produce what we need right now. Here's a couple of quotes from some oil CEOs just in this last month. Our plan now for 2022 is let's just keep our volumes flat. Another quote, whether it's $150 oil or $200 oil, we're not going to change our growth plans. So, you know, maybe my economics is a little rusty, but I know yours certainly isn't, Dr. Zandi. Is that how supply and demand is supposed to work?
No, and yeah, I do think, though, Congresswoman, we are starting to see the economic incentives starting to work. If you look at rig counts, they're double what they were at the pre-pandemic low, and in the last 6 to 8 weeks, they have picked up sharply. And I suspect now that we're at $120 oil, we will see the oil rigs really ramp up. So, you know, I don't have a perspective on the industry and how competitive or not it is. And it has been slow to respond to the higher prices, that's for sure. But it feels like it's kicking into gear now, and thank goodness for that, because we'll need that oil.
Well, I'm glad to hear that it's turning around and that they're actually going to start doing some production for us because we need it. You know, a couple of other things that the CEOs have been saying, the capital that historically we would spend in growing, now we're redeploying in the form of share repurchases. Another quote, we have to do what Wall Street wants or else your stock craters. This is my big concern, that Americans, working Americans, are suffering as more money is being put in shareholder pockets. And so this is while company after company is reporting record-free cash flows. Those calls for more oil production shouldn't be coming to Washington. They absolutely need to be going to Wall Street, because that's who is really demanding that oil companies not increase their production. So thank you so much for your testimony here today. I yield back.
Gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes.
Thank you to the chairman, and thank you for the witnesses for appearing today. Dr. Goodspeed, if I could with you, the Consumer Price Index has gotten a lot of attention. Of course, we saw the numbers last month that registered in at 7.5%, which were higher than I think a number of economists were thinking. The number that I've seen that's expected when the CPI number comes out later this week is 7.9%. In historical terms, can you reference that? We know that when the number came out last month, that was the highest number that we've seen in 40 years. Where does 7.9 register? What does that mean for the average American and consumer?
Thank you, Congressman. So that frankly is a level of inflation that we have not observed since the late stages of the great inflation of the 1960s to the early 1980s. And I would add that it might very well be higher than that if we calculated CPI the way we did before 1983. The 1983 was an improvement, but prior to 1983, home prices directly entered into the calculation of CPI, and I suspect that if they did again, then we would have actually seen even higher inflation than 7.5%.
And in your opinion, what would 7.9%, if that number is real and it projects that way when it comes out later this week, what would that mean for the average American? What does that reflect?
I think that reflects substantial decline in purchasing power, even greater than that which we observed in 2021, when in inflation-adjusted terms, wages actually declined in 2021, and they declined by various measures between 2% and 3%, because even though wages went up, they did not go up by enough to keep pace with the surge in inflation.
The markets, as anybody who knows who opens up their brokerage statement or logs online and looks at it, we know that the markets have been tumultuous, certainly over the last several weeks. You have an opinion of how the markets feel about government spending and increased government spending?
I mean, I think markets are reflecting a great deal of factors, geopolitical uncertainty included, concerns about fiscal excess necessitating tightening by the Federal Reserve. I would add, when we're talking about asset classes, one of the ways in which inflation really hurts lower and middle income households is through the fact that they don't have the same hedges against inflation that higher income households have. Higher income households are more exposed to equity markets. Higher income households tend to own their own homes, so they are better hedged against inflation than lower income households.
Thank you, Dr. Goodspeed. Mr. Zaney, if I could with you, talk to you about the travel and the airline industry for a moment. I know during this hearing, been a lot of questions about high energy prices. The airline and travel industries, we know, has been through a roller coaster with the pandemic. We all fly. We've seen increased capacity, although I'm not sure that the business traveler has returned to his or her pre-pandemic level. But with high energy prices, at what point do the airlines look at the price of a barrel of oil and decide that it's not profitable and start parking airplanes?
I think we're a long way from that. Although you make a great point that the airline industry is, obviously very energy intensive, and as prices rise, fuel costs rise, it's going to make it very difficult for them to earn money. Their profitability is going to be under extreme pressure. At least that's been the case historically, and I would be surprised if that isn't the case here as well. But I don't, they may pull back on expansion plans. They may pull back on particularly on profitable routes. But I don't think they'll do this in a widespread way, because the other thing that's going to happen is I do think demand is picking up. Business travel, as you point out, has been very depressed. But now that we're on the other side of Omicron, offices are reopening, particularly in the big urban centers that are globalized, and we're going to see more business travel. So I'd be surprised, Congressman, if we actually saw the airline industry go that park planes on tarmacs.
To make up for their margins, if oil continues to increase, they would have to raise their prices, wouldn't they?
Yeah, sure, and I'm sure they will. To try to compensate.
Thank you. I yield back.
Gentleman from Illinois, Mr. Caston, who is also the Vice Chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Our memories are short in this town, but I want to remind everybody that 2 years ago this month, we were looking at the biggest ever collapse in GDP in our history, the biggest ever spike in unemployment in our history. And if I would have told you then, don't worry about it. 2 years from now, we're going to have 300 million Americans vaccinated. We're going to have employers creating jobs at a faster rate than the workforce is growing. And we're going to have Republicans and Democrats united across the aisle to support NATO, to provide defensive weapons to Ukraine, and stand up to Vladimir Putin. You would have told me I was smoking some funny cigarettes. But here we are. And I do not mean to make light of the challenges Americans face today, but I think I speak for all Americans when I say I'm a lot happier to be here than where we were just 2 years ago. That rate of change is extremely disorienting. It's hard to understand. It's hard to process. And so I want to start with just some real simple questions. Dr. Goodspeed, if I gave you a 9.2% raise in your income and your expenses went up by 5.6%, would you have more or less money in your wallet at the end of the year? You would have less money if your income went up at 9.2% and your 9.2% raise and a 5.6% increase in your expenses. Okay, I just described the 2021 wage growth in the United States and core inflation. And when we only talk about income growth or we only talk about expense growth, it's a one-hand clapping conversation. What matters to Americans is how much money is left in their bank, not what's the end. And indeed, we've seen a $2 trillion increase in savings in the last year. You also mentioned, Dr. Goodspeed, that the U.S. inflation rate, I think if I got you right, is the 5th highest among the G20 countries. Where is our wage growth among G20 countries?
I noted that among 46 economies tracked by the OECD, the increase in average inflation in 2021 relative to pre-pandemic was the 4th highest in the United States. Okay,
close. I'm just saying that among G20 countries, what is our rate of wage growth? Because I want to make sure we focus on not one-hand clapping.
I do not, off the top of my head, know wage
well,
growth.
I'll help you out. It's the second fastest rate, and in fact, the third spot is the UK, which is just half of our rate. So it's a long drop from the silver medal podium to the third medal podium. How does our GDP growth compare over the last year to the rest of the G20?
Our GDP growth over the past year has outpaced most of, if not all of, the rest of the G20.
Yeah, I think we're the 8th fastest. Interestingly enough, the number 1 through 3 spots are Argentina, Turkey, and Saudi Arabia. I think it's safe to say none of us want to emulate their economic policies, but they are seeing rapid GDP growth. It seems to me that yes, we have had rapid inflation growth, but we've been at the top of the league tables thanks to a lot of what we did. We would not be there but for those changes. So, Mr. Drummer, I'd like to start with you. I'm under no illusions that 9.2% wage growth has accrued to every single American. Can you take a minute and tell us what you see that we've done from a policy perspective to drive that wage growth, and what we can do to make sure that those gains are shared by all Americans going forward?
Thank you. Thank you, Representative. Excellent question. So average wages for U.S. workers grew by 4.7%. It was the highest growth in 2 decades. However, inflation also grew by 7% during the same time, meaning that
I'm sorry, let me just interrupt you there, because the Bureau of Economic Analysis said 9.2% average wage growth in 2021. I just want to make sure I'm not...
To my knowledge, the Bureau of Economic Analysis doesn't report average wage growth. The average wage growth would be from the Bureau of Labor Statistics.
BLS, I'm sorry, but the data I've seen is 9.2%.
I think that's wage and salary growth. I'm pretty confident that's wage and salary growth.
Okay. I'm sorry to interrupt, Mr. Drummer, but I just want to make sure that we're...
All right, but to your point, we can get to the point here. That is a reflection. The wage growth is a reflection of what happens when we have expansionary monetary fiscal policy. We don't get growth in our economy without stimulating our economy. And I mean, that's pretty much what it comes down to. Now, unfortunately, we do see that the fastest wage growth did happen for the lower quartile, but they were coming up from a pretty low number. And that wage growth still isn't enough. And this is why the rate increase is so dangerous. We're about to claw back those gains that they just had after decades of relative stagnation.
Dr. Zandi, with the time left, anything you want to add as far as what we've done from a policy perspective to make sure that we're at the top of those league tables on GDP growth and wage growth, and what we can do, what we should be doing going forward to make sure we maintain those gains?
I thought the policy response, the fiscal policy response in particular, and the American Rescue Plan more specifically, was a slam dunk positive for the economy. And I think it's critical to getting the economy back to full employment as quickly as it has, faster than almost any other economic recovery. And I don't believe that it's contributed in any meaningful way to inflation.
Gentleman's time has expired.
Yeah, you're back.
Gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Mr. Chair. First, I want to submit for the record a CNBC article entitled "Inflation Eroded Pay by 1.7% Over the Past Year" by Greg Iaccarusi.
Without objection.
Thank you. There's a bit of debate as to whether the real inflation rate, or I'm sorry, real wage growth was negative, and I think that hopefully helps put it in context. So we're talking about historic inflation here, and for the 2012 to 20 period, prices were relatively stable, and much of the prior period. And so the question is always, what changed? What actually changed? If you listen to the chair and some of the witnesses today, it seems to suggest that the idea is we should be spending more and we should keep rates low, and that will somehow correct inflation. I want to start with Dr. Goodspeed. Do you have any reason to believe that corporations are greedier today than they were 4 years ago?
I have no evidence, nor have I seen any academic study to that effect, no.
So this notion that greedy corporations are somehow driving inflation, I would argue that relative greed amongst corporations is pretty stable over time, is sort of silly as an explanation for inflation. And it's notable that Chairman Powell, when he was before our committee last week, disputed that. And Secretary Yellen and the Treasury Department rejects that explanation as well. She didn't mention it a single time when she was before our committee. And so I think it's disingenuous to say the least. Another thing I'm hearing is that we should keep rates low while also complaining about housing prices, which housing prices are high. Dr. Goodspeed, again, what impact do 0% interest rates have on the price of housing?
They have a very substantial impact on the price of housing because you are discounting the future flow of housing services at a much lower rate. And so that tends to increase demand for housing and increase the price of housing.
So when the Fed lowers rates to 0 as the pandemic onset, not surprising that we saw demand increase and therefore prices increase. We saw it in housing, but we saw it in most markets. Fair?
That is fair.
Okay. And so this idea that we should keep rates low and that's going to somehow solve the housing problem, boy, somebody's going to have to explain that one to me. Now we're going to talk about another thing that changed, which is in the summer of 2020, the Federal Reserve updated its statement on longer run goals and monetary policy strategy to state that the Fed would seek to achieve inflation above 2% for some time after periods of low inflation. So that's a significant change. Given the persistent increase in inflation over the last year, do you believe that this policy hindered the Fed's ability to act sooner to address rising inflation? Or could you see where it might have?
I don't think that the policy change should have hindered. They still could have responded earlier, and I think they should have responded earlier. I fear that they may have overemphasized the flexible part of flexible average inflation targeting.
Thank you. And I wish that this chart were easier to see. I know these are hard to see, but basically, this is personal goods expenditure from pre-COVID levels. If you look before the inflation, or I'm sorry, the recession, more or less, demand is fairly stable over time. Here you see massive jumps in durable goods, here, here, and here, where these arrows are, all correlated almost perfectly with the fiscal stimulus. The CARES Act, March 27th, 2020, you saw a massive increase in demand on durable goods. Bipartisan COVID relief bill, December 21st, again, you see a massive increase in the demand for durable goods. American Rescue Plan, March 11th, 2021, massive increase in demand for durable goods. These are all things that have changed. And so when you think about what's driving inflation, I think it's fairly obvious. We have rates that are at zero. We had a pandemic, we responded. I voted for most of that stuff, frankly. I didn't vote for American Rescue Plan. Massive fiscal stimulus. And so you've seen a shift in the demand dynamics. What you have not seen is what the chairwoman and some of our witnesses seem to suggest, which is that there's evidence that corporations are somehow greedier today than they were 5 years ago. I don't think anybody would make that claim, but it seems to be the one that we're hearing. And so with that, I yield back.
The gentlewoman from Massachusetts, Ms. Presley, who is also the vice chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thank you, Mr. Chair. Workers, families, and small businesses in my district, the Massachusetts 7th, and around the country are feeling the impact of higher prices on everything from groceries to diapers to medication and other essential necessities. Corporations, they're claiming that they have no choice but to pass costs on to consumers due to inflation and supply chain bottlenecks. But their profits are telling a different story. Mr. Vahisan, isn't it true that most large corporations reported greater profits in 2021 than prior to the pandemic?
That's correct, Congresswoman. Corporate profit margins were at a 12-year high in 2021. And importantly, markets across the economy are already highly concentrated, but inflation has given many corporations cover to exercise their pricing power. And CEOs and CFOs have gone on the record to say that they can exercise pricing power that they couldn't before.
So 2 out of 3 of the largest publicly traded companies reported profits in 2021, more profits than they did in 2019, at a time of a global pandemic and a pandemic-induced recession, when people are struggling to make ends meet. Corporations like Amazon, Kroger, and Starbucks are not only hauling in massive profits, but they are also still raising prices. This doesn't sound like they're simply, quote, passing costs on to consumers, unquote. That sounds like corporate price gouging. Mr. Vahisan, for those following from home who hear this term but don't exactly know what it means, even though they're feeling the impact of it every day, can you briefly describe what price gouging is and how it impacts consumers?
So price gouging really comes in 2 forms. The first is when a firm exercises monopoly or oligopoly power to unilaterally raise prices far in excess of costs. And that seems to be in action in industries such as beef, where processors are raising prices to consumers while keeping prices down to ranchers. The second phenomenon is collusion, where a group of firms come together to jointly raise prices far in excess of costs. And that seems to be happening in poultry processing. In fact, a number of processors have been indicted and face private lawsuits over collusive activity. So those are the 2 types of price gouging that commonly happen in the economy.
Thank you. And I'll give another sort of real-time example that I certainly hear from constituents every day. So take Procter & Gamble, for example. They have repeatedly raised prices on their products during the pandemic, including diapers, while increasing their CEO pay, stock buybacks, and dividends, and raking in $21 billion with a B in net sales last year. So these price hikes are rooted in corporate greed, plain and simple, and our low-income families will continue to pay the highest price. Dr. Mabood, are we seeing price gouging occur in just 1 or 2 sectors of the economy, or would you say it's more of a broader problem?
Thank you for that question. My organization, the Groundwork Collaborative, has combed through hundreds and hundreds of earnings calls over the last 3 quarters. And what we see is in sector after sector, this type of pandemic profiteering is really, really rampant. And part of the reason we're seeing such widespread profiteering is because these CEOs and corporate executives are being egged on by their shareholders, right? Because when prices go up, and there are higher profit margins, like we've been seeing record profit margins, the demand from investors is, yeah, keep doing that play, push the prices up even more so we can push profits up even more. And so the concern here is that that investor scaffolding that undergirds our entire economy will keep prices elevated for a longer period of time and allow these huge companies to get rich while all of us pay the price.
Thank you. And this isn't just about the exploitive nature of price gouging by large corporations. It's also about investigating how and why they have the power to do so.
Absolutely. In many ways, pandemic profiteering is like that little blinking red light that says the whole switchboard is going down, right? And what we essentially have is 50 years of policy decisions that have led to a brittle supply chain and mega corporations really shaping a system so it works for them and not for others. And as a result, when we have a moment of inflation, and we're hearing this on the earnings calls, you know, executives are saying, you know, inflation is helping us with some cover to raise prices. And by the way, we can raise prices without losing market share because we're so big that our consumers have nowhere else to go.
Thank you.
Gentlewoman yields. The gentleman from Michigan, Mr. Huizenga, is now recognized for 5 minutes.
Thank you, Mr. Chair. The funeral of one of our colleagues, Jim Hagedorn.
Mr. Huizenga,
I'm sure all of my colleagues.
Mr. Huizenga, you have come in with some buffering issues. Do you want to start over?
Sure. Yeah. Sorry about that. I apologize for that. I'm on my way to the funeral of one of our colleagues, Jim Hagedorn, who I know all of my colleagues are thinking of his family today. So apologize as I'm in the vehicle doing this, but some pretty amazing statements being made throughout the day. Prices are up because of corporate greed, so then I must assume that gas prices were low because these same corporations were not greedy a year ago. Amazon has record profits because they're greedy, not because people are using them more. And trust me, I am no fan of Amazon per se, but you know, another statement: ruthless efficiency has brought higher prices. The views on how the economy works are clearly very disjointed here within the committee. I do want to ask that Mr. Goodspeed here, just to explain why inflation is hurting those middle and lower income families that I represent. I have the second poorest county in the state of Michigan. It's one of the top 100 poorest counties in the nation. It's very rural. It has a significant minority population, and I'm worried about them, not the top quartile. I'm worried about the bottom and the second and the third quartile of income earners. So if you could address that, Mr. Goodspeed.
Thank you, Congressman. And on the subject of workers and how inflation is impacting them, I would just like to note for the record that I'm not familiar with the 9.2% figure cited by the congressman from Illinois. Insofar as I can tell, he is referencing nominal aggregate wage and salary income as reported by the Bureau of Economic Analysis. That is economy-wide. That is something very different from average wage growth as measured either by average hourly earnings or average weekly earnings or the employment cost index. So I would just like to note that for the record. In terms of your question, Mr. Congressman, yes, inflation can be particularly difficult for middle and lower income Americans because they tend to have lower bargaining power, so it's more difficult for them it's more difficult for their wages to keep pace with inflation. Second, things like rent, gas, groceries, utilities tend to account for a higher share of their disposable personal income. And finally, as I've noted in my testimony, they tend to be less exposed to classic inflation hedges like equity markets and like owner-occupied real estate.
So, and how would you respond to these calls for more federal spending, that we haven't been spending enough, and that more stimulus is going to help those families that you were just talking about?
Well, I think that more federal spending is likely to continue to put upward pressure on real estate, on interest rates. That is not good for most households. I think more federal spending is likely to exacerbate a lot of the inflationary pressure. And in the long run, I don't think it's sustainable. So that implies a higher future tax liability for ordinary Americans.
On a previous hearing, I took the adage, when you're a hammer, everything looks like a nail, and converted it to when you're a modern monetary theorist or a neo-Keynesian, everything looks like a spending opportunity. And I think that's exactly what the debate is here today, whether we are going to pour more fuel on the inflationary fire that we have here. And maybe we'll finish with this, Mr. Goodspeed. How does fiscal discipline, regulatory right sizing, and private sector investment rather than government sector investment help families like those in my district?
Well, I think we ran that experiment, Mr. Congressman, in 2017, 2018, 2019, and the result was, as I noted earlier, real wage growth for the bottom 10% of the wage distribution of 9.8% versus real wage growth for the top 10% of 4.8%. We saw declining wealth inequality, declining income inequality, and we saw real median household income grow by $4,400, which was more in 1 year than in the preceding 16 combined. I think that's the result of the sort of policy mix to which you referred.
All right, I appreciate that, and with that, I will yield back.
The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you to the chairman, and I thank all of our witnesses for your time and testimony and expertise today. I want to follow up on a question that I asked of the Federal Reserve Chair just last week, Chair Powell, at our hearing. I've voiced my concerns about increasing market concentration and the role it has played in contributing to the fragility of our supply chain. I'm thinking, and some of you have spoken to it, in the beef and poultry industry, for example, and its connection to inflation. In response to my question, Mr. Powell downplayed the role of market concentration, noting that it is not a settled question, and he defers to the competition authorities. Many of you on this panel see it differently, so maybe I'll start with Dr. Mahbood and Mr. Van Heesen. Can you please speak more to the market concentration and its impact on inflation?
Sure, thank you for that question. So corporate consolidation and just bigness in our economy has really helped facilitated the price hikes that we're seeing today. You know, with control and dominance over these markets, these massive corporations can raise prices and pass along costs to consumers who have nowhere else to turn. I mean, think about if you're a family, again, who needs diapers, and all of the diaper brands we're all familiar with are made by 2 diaper companies, and the prices are going up. You know, those companies know that they can get away with it because families are not going to go without diapers. You know, pandemic profiteering is really just one symptom of an economy that prioritizes profits, all while decimating the economic security of millions around the country, and who faced a broken economy for decades. It's kind of the tip of the iceberg in many ways. And I'm happy to speak more to the supply chain aspect of this too, but we'll let my colleague on the panel go next.
Mr. Van Heesen.
Yes, that's exactly right. So corporate concentration has contributed to higher unilateral pricing power on the part of businesses, so they can raise prices, raise profit margins without losing a large volume of sales. Second, in concentrated markets, it's easier for companies to come together and collude. And as a number of members and have noted today, markets were very concentrated before the pandemic. That's certainly true. But inflation in excess of 7% has given powerful corporations the freedom to approach their purchasers, whether they're wholesalers and retailers, and say, look, inflation is up, we want to raise prices. And they didn't have that cover before, so it's easier to broach the topic of price increases without jeopardizing their relationship with purchasers. And I think second, I would add, 40 years of mergers and acquisitions have meant that companies have plowed money into buying other companies instead of investing in new capacity. And the pandemic has really exposed the fragile nature of many of our supply chains and the lack of economic resiliency.
Thank you very much, both of you. Dr. Zandi, it's good to see you, fellow Philadelphian, Pennsylvanian. I want to take good to see you. Maybe tacking on to this question about concentrations in the market and inflation, what are some solutions that we here in Congress can apply? And then I have another question for you after that.
Sure. I do think it is very important that you have hearings like this to shine a bright light on these practices. And in fact, you may want to dig deeper into each of these industries where there is concern about competition in the meatpacking industry or the energy industry, just so that everyone, I think that's a very fundamental role of government to make sure that everyone's playing by the rules, particularly in a time of crisis, and we are deeply in crisis. So I think that's very key. And then secondly, making sure that the antitrust laws are in the shape they need to be in. And I know there's been a lot of work, both in the Senate and the House, around taking a good hard look at our antitrust laws and making sure they're up to the challenges that exist today. So I think those are very important things to do, just to make sure that businesses are playing by the rules in these markets in a time of stress.
And following up on the American Rescue Plan that I was very proud to be a small part of and a vote yes for about a year ago. Sadly, some of my friends on the other side of the aisle have been spinning about the American Rescue Plan and inflation as though it were to blame for the inflation that we are seeing entirely in this country, and we all know that it is a global phenomenon. Can you speak to that set of myths?
Yeah, the American Rescue Plan did help demand, but that was a year ago, and that coincided with the vaccinations and the reopening of the economy. So inflation picked up, but that was deemed to be okay because we had been through a decade or more of low inflation, suboptimal inflation. The really difficult inflation came well after the American Rescue Plan and its impact on demand waned, and that was due to the pandemic and the Delta wave and the disruptions of supply chains. So
Gentlewoman's time has expired.
The inflation we're experiencing now is not due to the American Rescue Plan.
The gentlewoman's time has expired.
Thank you for that clarity, and I yield back.
The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Hey, Mr. Chairman. I've got to say the evolution of the so-called experts and the leftist politicians on inflation over the last year has been absolutely incredible to behold. When Republicans warned of inflation last year, while Democrats were spending like drunken sailors, we were shooed away and told that was crazy talk. Inflation was a thing of the past, et cetera. How their tune has changed. After calling us crazy, then it was transitory. Then it was only used cars, lumber, and gas. And then it was, and this is my favorite, a first-class problem. A first-class problem. The White House Chief of Staff literally described inflation as a first-class problem. But nothing could be further from the truth. And we aren't done yet. That wasn't the end of the evolution. Once my colleagues across the aisle started polling the issue and realized that what we've been saying all along, that inflation functions as a tax, a regressive tax, primarily hurting folks living paycheck to paycheck on fixed incomes who are just trying to make it until payday. Once they realized they could not wish away this problem, they had to start blaming it on something. But there have been no mea culpas. There has been no introspection to speak of, friends across the aisle. Instead, they're blaming their tried and true boogeyman, corporate America. Never mind the easy money policies of the Federal Reserve over the last 2 years. Never mind trillions of dollars of unneeded federal deficit spending poured into an otherwise healthy economy that was emerging from the pandemic. Last year, Democrats ignored Larry Summers when he joined Republicans and warned of the risk of inflation that the so-called American Rescue Plan posed. So what is our friend Mr. Summers, former Treasury Secretary to President Clinton and director of the National Economic Council to President Obama, saying about the Democrats' new plan to, quote, break up the evil and greedy corporate overlords inflation. The emerging claim that antitrust can combat inflation reflects science denial. There are many areas like transitory inflation where serious economists differ. Antitrust as an anti-inflation strategy is not one of them. One of the left's favorite boogeymen is the meatpacking industry. What does Larry Summers have to say about that? Quote, breaking up meatpacking would in the short run lead to reduced supply, which would further increase prices. In general, when government goes to war with industries, it discourages investment and subsequent capacity. I'm going to say that again. When government goes to war with industries, it discourages investment and subsequent capacity. So in plain English, what my friends on the other side of the aisle are proposing as a solution would only make things worse, subsequently making goods and services even more expensive for the American consumer. They ignored Larry Summers once. They would be wise not to ignore him again. So where do we go from here? Obviously, the Fed is the government institution with the greatest ability to curb inflationary pressure across the economy. And I'm glad to see that they're finally beginning to use their tools to address rising prices. Better late than never, I guess. Dr. Goodspeed, obviously in the energy sector, there are many steps Congress can take to address runaway inflation, namely increase production here at home. But looking at the big picture, besides immediately halting wasteful spending, what can Congress do to address this problem and provide relief to the American people? It's the least we could do given the actions of my colleagues across the aisle this last year.
Well, thank you, Congressman Timmons. I think three important things would be not only slowing the growth of federal spending, but also providing some certainty on the future direction of both personal and corporate income tax rates so that we can incentivize increased labor force participation, particularly among those of retirement age or near retirement age, 1.5 million of whom have exited employment early, and also by giving some certainty on the business tax side to incentivize increased business investment to increase capacity. And if I may, you articulated a policy situation that seemed eerily familiar to me to the last time that we saw demand excess from fiscal policy and a constrained labor force. And this is from Alan Meltzer writing about the origins of the Great Inflation in the 1960s. Quote, policymakers denied for several years that inflation had either begun or increased. They did not deny the numbers they saw, but like Gardner Ackley, the chairman of Johnson's CEA, they gave special explanations.
Thank you, Dr. Goodspeed. Thank you. Mr. Chairman, I yield back.
The gentlewoman from Texas, Ms. Garcia, who is also the vice chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to all the speakers who are here today to join us in a discussion of such a very important topic. It is important that we address the issue of inflation, but first we must identify the issues correctly. We cannot produce targeted strategic solutions without identifying the problems and where they're coming from. I know it's fun for some to blame the Biden administration for economic problems, but these problems, as you know, are global and far-reaching. We must dig deeper to understand some of the fundamentals, the economic structures we operate in that rig the game against lower and middle class Americans. My colleagues across the aisle have talked about upgrading America's aging infrastructure for years with no action. Instead of fixing and investing in the Americans' infrastructure, they spent $1.9 trillion in tax cuts to the wealthy. But while the previous administration only talked about infrastructure, we did it. Under the Biden administration, we've invested $550 billion in new infrastructure development, including $17 billion for ports and waterways. Bringing it home, I've always been a vocal supporter of the strategic significance my city plays and why I fought for us to invest in widening, deepening, and dredging our port, the Port of Houston, so it can expeditiously move goods, keeping up with shipping containers becoming larger and heavier and shipping activity moving more frequently. That is critical American infrastructure work. Dr. Sandhi, in your testimony, you referenced the supply chain bottlenecks as a major factor in contributing to the shortage of goods, thus causing prices to rise. Do you agree that it's important that we invest in American ports and waterways? And how will the projects funded by the infrastructure law reduce the supply chain backlog?
Thank you for the question, Congresswoman. Absolutely. I think that infrastructure legislation was a critical piece of legislation, both in terms of addressing near-term inflationary issues related to supply chain disruptions, and that's roads and bridges, seaports and airports. There's significant amounts of new funding for all of those things in that infrastructure legislation. I also think it's very important for long-term economic growth because I do think it lowers the cost of doing business, makes U.S. businesses more competitive globally, and will lift overall productivity growth. And that will also help with, it raises our standard of living, all Americans, and it lowers inflationary pressures going forward. The only criticism I would have is it's too small. I mean, we've been under investing in our infrastructure, everything from our water systems to broadband to you name it. We've been underestimating for decades, and there's a big shortfall, and we need to invest even more. And I think the benefits of that are very obvious.
Thank you. Going on to my next question, Dr. Mahbood. From auto companies to hotels to restaurants to retailers, earnings calls show that many corporations are looking to their competitors and taking advantage of unusual pandemic conditions and supply chain challenges to pass on the higher prices. Some speakers before me have mentioned that. Last year, Kroger's CEO said, quote, and this is a direct quote, "A little bit of inflation is always good in our business. Pass off costs to consumers when it makes sense to do so." Can you share examples from these earnings calls of price gouging or profiteering?
Yes, thank you for that question. Johnson & Johnson is actually a great example. The company expects to make more than $3 billion from its COVID-19 vaccine in 2022, which I think it's worth noting that is the result of more than $1 billion of federal funding for research and development. And these vaccine profits are on top of the price increases it has set for 29 other prescription drugs in this year alone. And on these earnings calls, Johnson & Johnson's CEO is really candid about the company's potential to profit from future human suffering. He noted, quote, "We remain optimistic on the fact that strong underlying demand for healthcare is there, and there's still a lot to do in multiple diseases in order to address suffering and death. In other words, future opportunities to profiteer from public health crises." And as I've testified, this is not something that's limited just to the grocery sector or the healthcare sector. These are really widespread issues.
Thank you. My next question is back to Dr. Sunday. Our colleagues at the other side of the aisle here really focused on federal spending as a biggest driver of inflation. However, they seem to forget that deficits went up every single year under the Trump administration as they passed their multi-trillion-dollar tax breaks for corporations and the wealthy. Do you feel that the American Rescue Plan of 2021 did raise or lower deficits this last year?
Gentleman's time has expired. Please be brief, Dr. Zandi.
Initially, it raises deficits because it was deficit finance, but without it, the economy would have been significantly diminished. And if you look out towards the middle end part of the decade, it would actually have resulted in the same deficits and debt if we had not done the American Rescue Plan. So,
gentleman's time has expired.
I don't think there was a choice here.
Thank you. How do you about, Mr. Chairman?
Gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Chairman. Appreciate our panel bringing your expertise to the committee. Rising prices and ongoing labor shortage are leading to substantial wage growth across many industries. The latest data from BLS shows the average hourly wages grew at 4.5% in the 12 months ending December. Of course, this is not real wage growth, which is at a loss since inflation is running 7.9%. While wage growth alone can be positive, it can lead to a vicious wage price spiral like we saw when I began my career in the 1970s. Particularly if higher prices and pay and excessive productivity feed into each other, drive up inflationary expectations, and lead to persistent inflation even after this supply chain issue abates. Further, these wage gains have been outpaced, as I note, by rising cost of everything from groceries to housing, meaning real wages are negative, and in fact, Mr. Chairman, real wages were negative in 8 of the last 12 months. Dr. Zandi, in your testimony, you talk about inflation expectations, which this is a key component of. You describe them as appearing fragile and bear close watching. You suggest it's hard to see how the Fed can tolerate this for long, knowing based on the experience of the 1970s and 80s that the economic cost of waiting too long to short-circuit wage price spirals is extraordinarily high. What do you expect the inflation number to be, the CPI on Thursday, ballpark? Let me ask you, if you don't want to give an answer, what are analysts suggesting is the range for CPI for Thursday?
It's somewhere between 7.5% 8% year over year, Congressman.
Right. Thank you, Dr. Zandi. And I'm concerned that when you see this kind of issue, when I talk to HR directors and chief financial officers and company presidents all over the country, you're really getting this inflation embedded into their infrastructure, not just through costs, but through labor shortages. And let me ask you, Dr. Goodspeed, if we make it harder to hire people through additional regulatory burdens on small businesses, vaccine mandates, get into an argument about how old you have to be to drive a truck and all this kind of thing and how many hours, does this drive up wages when you have these kinds of severe shortages?
Thank you, Congressman. I think what it means is that there's going to, for any given level of unemployment, there's going to be a greater degree of inflationary pressure. When we look at the efficiency of labor market matching in the United States, the efficiency with which unemployed workers are matched to vacant jobs, the U.S. labor market has not been performing this poorly since the late 1970s. This is the Beveridge curve relationship.
Yeah, and so that's, I think, very concerning to me and to my colleagues who keep trying to rewrite history. Deficit spending during the CARES Act was bipartisan. There's no doubt about that. We didn't know what was going to happen in 2020, and we spent $6 trillion in addition to the money that we also spent by way of the Federal Reserve. And so the logic I think Larry Summers laid out was don't spend more. That's the American Rescue Plan argument. You've already stimulated the economy way too much, plus the monetary policy issue. Dr. Goodspeed, let me turn to you now about the components of CPI. I'm very pessimistic that somehow we're going to get a break and that number is going to go down. And I want to ask you specifically about the housing component. Housing's 30% of CPI and about 40% of core CPI, but the method of calculating housing, both rental and single-family ownership, in my view, understates the real experienced inflationary cost in the economy. Is that how you understand the CPI calculation?
The CPI calculation does understate the inflation in housing that I think ordinary Americans feel because for the rental component, it only measures new leases, continuing leases, whereas it's in new leases that we've seen double-digit increases in rent.
Yeah, so that understating, I think my colleagues need to understand, we're going to have higher CPI numbers coming as a result of this increase in demand and wage pressure. For example, house price inflation, the CPI from December 20 to 21 was stated at 5%. 5%. But when you look at the new home price index, it was up 18%. And you look at single-family rent prices on this point of new, it was up 12%. So I think we're going to continue to see inflation, and I think it's driven, just as Milton Friedman promised us, as a monetary phenomena, and we have overstimulated the economy and fiscal policy, and we have mishandled our monetary policy, and I yield back.
The gentleman from Guam, Mr. San Nicolas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I want to begin by clearly acknowledging that the inflation that's devastating this country and everyday hardworking Americans is just terrible. It's terrible. And the circumstances that we're all dealing with here today is something that we all need to grapple with. I wanted to first open, however, Mr. Chairman, with a question to Dr. Zandi. We're dealing with inflation today. But isn't it true that the actions we took with respect to the fiscal policy that we initiated, that actually prevented a worse circumstance from happening, which is stagflation? Would you agree?
Yeah, I think the odds that we would get into a stagflationary environment, which just for everyone's edification is very weak growth and high inflation, would be much higher. Right now we have high inflation, but we have very, very strong growth, lots of jobs, and we're getting back to full employment very quickly. So I would agree with that.
And just to clarify, from an economist perspective, stagflation on its impact on the on society would be materially worse than inflation. Is that correct?
Yes, because that means both higher inflation and higher unemployment. Right now, obviously the high inflation, as you point out, is very painful for Americans. But fortunately, we have a low unemployment rate that's falling very rapidly, and that's good for for all Americans. But in a stagflation environment, you've got both rising inflation and rising unemployment. Nothing worse than that. I mean, that would be very difficult. And that's what we had in the 70s and 80s, and that's what we need to avoid.
And just to really put into context the circumstances we were dealing with, the Fed rate was at or near zero when the pandemic hit, and so the monetary policy options that we had were very limited with respect to its comparative alternative, which was the fiscal policy that we initiated here in the Congress. So would you agree that the fiscal policy initiative that we undertook to really fund us out of this pandemic was materially responsible for preventing us from entering into a stagflationary scenario?
Yeah, I think that's fair to say. I think the very aggressive fiscal policy response, beginning with the CARES Act 2 years ago in March of 2020, there was a number of other pieces of legislation, a piece of legislation that was deficit financed in December of 2020, and then the American Rescue Plan, which was March of 2021. All of that together was critical to ensuring that this economy has been able to recover as fast as it has. And just to give you a sense of that, we are going to be at full employment 3 years after the pandemic hit us. And that, obviously remembering back, that was a harrowing period, and we've made our way back in 3 years. Typically, coming out of recessions since World War II, it takes double that, more than 6 years. And of course, after the financial crisis, which hit us over a decade ago, it took us 10 years to get out. So, from that prism, because of the fiscal policy response and including the American Rescue Plan, we have recovered very, very dramatically. There's nothing but good news as a result of that.
Thank you for that. There is bad news, and the bad news is we're still dealing with inflation. I think we need to tackle that. I think that the American people demand us to tackle that, and I very much agree. The inflation that we're dealing with, we've been arguing back and forth about all the different component parts. One of the really main points that's been brought up over and over again is the indication that the increase in profits is being realized by corporations is a sign that corporate profiteering is contributing to the inflationary calculation. I want to contextualize it more specifically, though, because profits can be as a result of market share accumulation due to pandemic circumstances. I think that the more important question is, has margins increased? Have the margins of these corporations increased dramatically pre-pandemic, pandemic, and post-pandemic as we get into post-pandemic? And so I wanted to pose that question to Dr. Mahbood. Are we seeing significant margin increases? Because that would be indicative of profiteering, because then the input prices, although they may be increasing due to supply constraints, they're actually not translating on a dollar for dollar basis onto the actual price points. Would you be able to comment on that, Dr. Mahbood?
Yes, I mean, that's spot on. In the past 2 quarters, U.S. corporations outside of the financial industry posted their fattest profit margins in 70 years. And when we contextualize that within two years plus of a global pandemic, when so many people are suffering around the country, it really points to the fact that we have way too much corporate power, and they're able to, as the CEO from Kroger said, a little bit of inflation is good for business, and taking advantage of that.
The gentleman's time has expired. The gentleman from Wisconsin, Mr. Stile, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. I appreciate you holding today's hearing. People are getting clobbered with inflation. When I'm home in Wisconsin, people are going to the gas pump, they're feeling it. People go to the grocery store, they're feeling it. People are getting clobbered day in and day out. And inflation impacts everybody, but it really clobbers seniors on fixed incomes and low-income workers. And low-income workers are taking it on the chin right now. it was suggested by one of my Democratic colleagues that Republicans were having fun blaming Biden. This isn't fun at all. People are getting clobbered by higher prices. They're getting clobbered by higher prices, and we got to get to the answer of the policies that are driving it. And I think it's very interesting. We've heard about corporate concentration. I'm guessing that polls pretty well. Do you think that polls pretty well, Mr. Godspeed, to blame it on corporate concentration and corporate greed?
The polling and politics are outside my area of expertise. I would imagine if the claim is being made, then presumably someone sees some.
Yeah, that'd be my guess. It was interesting. I was looking at your presentation and following along kind of the Eurozone against the United States. Inflation between the Eurozone and the United States tracked pretty closely over the past 15, 20 years. Is that accurate?
That is accurate.
And then all of a sudden, there was this massive deviation between the Eurozone and the United States. Is that accurate?
Correct.
Roughly about when did that break start to occur?
March 2021.
So March 2021. So then the question would be, what occurred, rough math, around March 2021 that might have driven this? So the proposal that I've been hearing earlier is that all of a sudden corporate greed in the United States took off. But interestingly, the data might suggest that it didn't take off in the Eurozone. Would that be a reasonable inference, Mr. Goodspeed?
Yes, it would.
So interesting. What would be the Biden administration's policy that was allowing corporate greed in the United States that wasn't taking place in the Eurozone at this time? Because previously, inflation between the United States and the Eurozone was tracking pretty consistently. Then we have a break, huge deviation, triple the inflation in the United States than the Eurozone has been experiencing. Is that correct?
That's correct.
And so then the logic would say, okay, so if corporate greed and concentration is driving this in the United States, why did the corporations all of a sudden decide, once the Biden administration came in, the Biden Department of Justice, do you think these corporations sat down and said, aha, we got a Biden Department of Justice, we have one-party Democratic rule in Washington, D.C., now's the time to go and drive greedy profits up? Do you think that occurred?
I've seen no evidence to suggest it occurred.
Were there any policies that shifted in the Biden administration or under one Democratic Party rule, specifically as it relates to corporate greed and profits, that would have driven these corporations to drive up profits? No. Did they say, we're going to stop enforcing some certain policy, that they're going to have a massive change on antitrust regulation that would have said, these corporations would have said, boom, now's the time to go?
None that I'm aware of.
Yeah, and so the data shows that consistency in the Obama administration, the Trump administration, and then all of a sudden this massive deviation, you'd almost think that suddenly spending took off in Washington, D.C. this year.
I think that is the $1.9 trillion elephant in the room.
Did the Eurozone have a massive, ginormous increase in spending that they saw that paralleled the United States?
Neither of the same magnitude in 2020, nor anywhere close to the same magnitude in 2021.
Interesting. So we have this massive deviation that occurs. You have not identified any policies that would have allowed corporate greed to take off uniquely under the Biden administration. We have problems with corporate greed on occasions, right? And we should dig into that. We don't want that to occur. But you haven't identified any unique policies in the Biden administration that's uniquely weak as it relates to corporate greed or enforcement. I haven't heard any of my colleagues suggest a specific policy of weakness in the Biden administration on that we need to dive into. But we have noted all of a sudden a massive fiscal policy change once we had Democratic one-party rule here in Washington, D.C., driving huge demand increases, more money, chasing the same number of products can lead to inflation. And at the same time, we've had a monetary policy that has been pushing easy money. The balance sheet at the Fed has increased over $4 trillion over the last 2 years. The Fed's balance sheet continues to increase. So we have an easy money policy rather than sound money. We have massive fiscal spending. And I think we've identified the problem that's occurring, that's clobbering people in the pocketbooks in Washington. And I think we should wake up and change the policies here in Washington. Thank you very much, Mr. Chairman. I yield back.
The chair recognizes himself for 5 minutes. Dr. Mahbood, Dr. Goodspeed, Dr. Zandi, in that order, I have an energy question for you. This morning, President Biden announced a U.S. ban on Russian oil imports. This is a welcome step in ratcheting up pressure on the Kremlin. As I've been saying for weeks, though, to be effective, this action must be global. Working with our allies in NATO and beyond, the United States must cut off Russia from the world's oil market. The fossil fuel industry is not going to lead the free world. Americans need to. This ban will deprive the Kremlin of vital hard currency to sustain the ruble and fund its military and government. It will also, though, remove up to 5 million barrels a day from energy markets that are already surging in price, a primary driver of inflation here in the United States. To backfill these 5 million barrels in the short term as we transition to a long-term clean energy economy, OPEC could expand production by up to 2 million barrels, America by 1 million barrels, Canada, Brazil, and other smaller producers by up to 1 million barrels, and should a deal be reached, even Iran by up to 1 million barrels. It is also likely that some portion of the 5 million Russian barrels will end up on the market sold to buyers not complying with sanctions, though at a significantly discounted price. And finally, of course, the Biden administration and its allies can continue to use their strategic petroleum reserves to smooth out supply, although that's only 60 million barrels in a market that consumes 100 million daily, so that's going to have a marginal impact. As I said, starting with you, Dr. Mahbood, and then Dr. Goodspeed, and then Dr. Zandi, if there were a global embargo on Russian oil that was accompanied by the supply response that I have just outlined, would you expect that gasoline prices in the United States would rise beyond the highs they've hit in January?
Thank you for that question. Any hits to supply are going to raise prices. But I think what's really critical to remember is that our dependence on fossil fuels is keeping us tied to volatility. And so, yes, it's going to take a long time, but transitioning to and investing in a green economy is not only important for people and maintaining low energy prices for folks around the country, but also in ensuring that we have a planet that works for our economy. And I'll also harken back to what I said earlier, which is that we know that oil company executives are not immune from the type of profiteering that we've been talking about across the course of this call. First they use pandemic disruptions to massively boost their profits, and unfortunately now the conflict in Eastern Europe is providing another opportunity to pad their bottom lines. So again, going after profiteering in the fossil fuel industry is an important short-term imperative, and over the long term, we must not delay in making the long overdue investments in a clean energy economy.
Dr. Goodspeed.
I wasn't keeping track in my head the specific barrel amounts to which you referred, but I will say that 12% roughly of global oil production is from the Russian Federation, about 17% of gas production. I think even if, in theory, increased production from the United States, increased production from the Kingdom of Saudi Arabia and other OPEC members can compensate that, I think that there's going to be an adjustment period.
Right.
And production, because production of different types of oil in different regions of the world is not immediately substitutable. The infrastructure just isn't the same.
Have the markets, though, priced in those 2022 disruptions into the January price, or would you predict further inflation in gas prices?
I think as of a few weeks ago, even perhaps as recently as a week ago, markets were probably underpricing the upside risk. I haven't checked today what they're doing, but I would imagine that they are substantially revising their price expectations.
So you would expect that the January prices would have internalized much of the disruption risk of 2022, and also the potential to backfill.
I think throughout January into February, markets were substantially underpricing the risk of conflict and conflict escalation, including the oil market implications.
And Dr. Zandi?
I don't think markets are fully discounting what we're talking about. If there's broad-based sanctions on Russian oil, the U.S. stops buying and Europe stops buying and other advanced economies stop buying, I think we'd see prices closer to $150 per barrel, which means the cost of a gallon of regular unleaded is going to $5. If, however, it's just the U.S. and the Europeans don't go along, and there's a lot of discussion about that, then probably 125 is where we're going to land. And that would mean that we're going to see gasoline prices $4.50, $4.75 nationwide. So,
but Dr. Zandi, are you incorporating the supply response that I outlined, where there's coordination to backfill? You are. Okay.
Yes, because that's going to take time.
Yes.
That will not happen immediately. Yeah.
Dr. Mahbood, as a final request, would you be willing to offer into the record at a later date proposals, the short-term proposals that you have alluded to crack down on any war profiteering by big oil? I'd be interested for any of the specifics you have there.
I can follow up. Thank you.
The chair recognizes the gentleman from North Carolina, Mr. Budd, for 5 minutes.
I thank the chair and want to continue on with this theme. Dr. Goodspeed, again, thank you, and the whole panel, thank you for being here. So I've heard a lot of my colleagues across the aisle claim that the 40-year high inflation spike that we're currently experiencing is a result of corporate profiteering. Now, you would think that the nearly $2 trillion that the Democrats injected into the economy would be more of a culprit. As the economist Milton Friedman would say, there are just too many dollars chasing too few goods. Businesses are forced to accommodate the increased cost of production to meet demand needs. It's simply Econ 101. I think some of my colleagues should re-educate themselves on how basic supply and demand works. So I've got a bill, H.R. 5968, that addresses this, and it would require certain White House employees to receive training on economic literacy, and it's clear that they badly need it. I'm even thinking about expanding the bill to include members of Congress. So Dr. Goodspeed, is there any compelling evidence to suggest that inflation has hit this 40-year high because businesses are conducting so-called profiteering?
Thank you, Congressman. I've seen no evidence as to why corporate profiteering would have increased in 2021 relative to previous years, why corporate profiteering would have increased in the United States versus Europe. I've seen no evidence as to why we should observe not just an increase in prices, but an increase in the rate of change in prices and an increase in the rate of change in the rate of change in prices. And I've also not seen any evidence for why we should see general price inflation rather than simply relative price inflation in sectors with greater concentration.
Thank you. So both the Obama and the Biden administrations have blocked the development of the Keystone Pipeline. President Biden has also established a policy of opposing funding of oil and upstream natural gas projects through multilateral development banks. Oil prices are currently sitting at a 7-year high. The unjust invasion of Ukraine by Russia has also led to additional impacts on oil prices. And the New York Fed has been working on developing climate stress testing. So are there any concerns that additional regulations and stress testing that is hyper-focused on oil in particular can make the price concerns that we're currently seeing even worse? I'll just leave it at that. Do you think that what the Biden administration is doing and the Obama administration did do you think it could make things worse?
So as I noted in some of my earlier remarks, one very striking aspect of 2021 was the breakdown in the historic relationship between the price of oil and oil rig counts in the United States. As Dr. Zandi pointed out, we might expect that to recover in 2021 given the upward pressure on oil prices, considerable upward pressure on oil prices, but that relationship broke down, and I think that has something to do with the increased regulatory burden on the domestic energy industry and possibly some effects on capital allocation.
Continuing on, doesn't restricting the supply of oil and natural gas internationally increase the risk of inflation even further?
Yes.
I yield back. Thank you.
The gentleman yields back. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Madam Chair. Inflation is deeply regressive, imposing a disproportionate burden on the poorest families. The families who are hit hardest by inflation are the same families who would benefit the most from an expanded child tax credit. The regressive impact of inflation underscores the need to restore a progressive child tax credit. My first question is to Mr. Drummer. Do you believe, as I do, that the child tax credit could be a tool for mitigating the impact of inflation?
In short, absolutely. These investments in our economy, they are what saved our country from falling into a depression, and they lifted millions of children out of poverty. Absolutely.
And as you know, inflation is not equally distributed across the economy. Some sectors of the economy are more inflationary than others. And according to an analysis by the Center for Budget and Policy Priorities, the CTC monthly payments were most commonly spent on food, utilities, and housing. Food, utilities, and housing are among the most inflationary goods and services in the U.S. economy. Is that correct, Mr. Drummer?
That is right, and particularly energy is particularly volatile.
And so the child tax credit would essentially enable the families most affected by inflation to afford the life necessities most affected by inflation, the necessities of food, utilities, and housing.
That's right. The more money they have, the more they can absorb these fluctuations.
Mr. Zandi, in March of 2021, you co-authored a report entitled Overcoming the Nation's Daunting Housing Supply Shortage. The report, as I understand it, found that the annual demand for housing exceeds the annual supply of housing by 100,000 units, representing the largest shortfall in nearly half a century. The report also found that over a 10-year budget horizon, an annual investment of $50 billion in affordable housing could boost affordable housing construction by 275,000 units per year. You know, it's a common refrain among Republicans that government is not the solution, government is the problem. But in your professional opinion as an economist, can we even come close to solving the housing supply problem in America without government investments like the Build Back Better Act?
Not anytime soon, Congressman. It's a very pernicious problem that's developed over a period of more than a decade since the financial crisis. And the root causes of that are very, very pernicious and difficult to address around zoning, permitting, global supply chain issues and building materials and labor supply issues and construction land development lending. Very complex issue. And I don't think I think markets are starting to work. Home builders can make a return, and they're now starting to build homes that are more affordable at lower price points. But the way it's going to take a long, long time, and inflationary pressures are going to continue to develop because, again, housing is such a key component of overall inflation. So I would strongly recommend that lawmakers take this up. And I think there are a lot of good proposals that are bipartisan that can help to lower the cost of construction and get, particularly for affordable housing, around LIHTC, new neighborhood home tax credit, new market tax credits, home housing trust fund. These are things that could go a long way to quickly addressing this housing shortage and addressing one of the most significant contributors to inflation, beyond the current period.
And as you noted, when it comes to housing, there is one sense in which government is indeed a problem. Zoning, local zoning codes have essentially made it illegal to build affordable housing, multifamily housing, in much of the country. And so the housing affordability crisis must be solved not only with greater investment from the federal government, but also greater land use reform from state and local governments. I have a question about the American Rescue Plan. Among the wealthiest countries, the U.S. has seen the strongest economic recovery from COVID-19. The U.S. has seen historic highs in job creation, economic growth, and wage growth. Mr. Zandi, to what extent can the exceptionalism of America's recovery be attributed to the American Rescue Plan?
I think it's a very significant contributor. If you're interested, I just wrote a paper that I published last week. Just Google Zandi and the macroeconomic consequences of fiscal policy, global fiscal policy, and I go through the contribution that the ARP has made to our economic recovery and our economic success compared to other parts of the world. And again, just to reiterate, I think it is clearly why we're getting back to full employment very rapidly, much more quickly than the rest of the world, and much more quickly than we have historically coming out of recessions. And again, I do not think you could connect the dots between the uncomfortably high, painfully high inflation we're suffering right now back to the American Rescue Plan. It is related to the pandemic and now, of course, related to Russia-Ukraine.
The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you very much, Chairwoman. Who's in the chair right now. So all the
Ms. Adams, we're having trouble with your volume.
What about now?
If you could raise it just a tad or rearrange your microphone, we can barely hear you.
Can you hear me now?
A little bit better, but is there a way to raise that volume?
Raised it as far as I can.
Well, that's it right there. If you
Is it
lean
really?
in, if you lean in, we can.
Oh, Okay, so can you hear me now?
Yes, ma'am. Let's do like the book says, lean in.
I'm leaning in. Thank you, Madam
Thank you.
Chair, and to our
All
ranking
right, you
member,
have
to our
5
witness.
minutes.
Okay, thank you very much, and thank you very much to our chair and our ranking member, and thank you to our witnesses for your testimony. Let me drill down on components of the inflation that we're currently experiencing, the housing shortage. You don't need to take my word for it. Economists across the nation are saying the same thing. We need to increase our housing supply of new units, of affordable units, of all kinds of units, and we need to do so immediately. I'm proud that under Chairwoman Waters' leadership, this committee has advocated for the most robust investment in public and affordable housing in our nation's history. So, Dr. Zandy, in my district, research by the University of North Carolina, Charlotte, 11,000 family homes are now owned by private equity firms, other Wall Street-backed entities. So over 4% of the single
Ms.
family
Adams, if you
homes
could
in-
raise the volume, you're a little low again.
Okay, Dr. Zandy, to what extent has the current housing supply crunch been exacerbated by the excess of Wall Street and private equity firms?
Private equity firms and investors broadly, including institutional investors and mom and pop investors, Americans buying homes for investments, has risen quite significantly, particularly over the last year. So almost, a little over 1/4 of home sales at the end of last year were to investors, up about 10 percentage points from the year before. So they are playing a more active role in the housing market, and particularly in different parts of the country. The South and the West, come to mind relatively quickly. So they are having an impact on house prices, on affordability, on home ownership, and really having a meaningful impact on the dynamics of the housing market, and just making it more difficult for low-income Americans, first-time home buyers to afford that first home. I do think this, though, goes back to supply. I think we need to encourage investors to work to increase the supply of housing. So, for example, going back to investors, one thing they're doing now is they're buying homes and then renting them. We can design policies to incent them to build homes, to rent them, or for home ownership. And if we can do that, then we can address this problem. But it is increasingly, an issue that's beginning to affect more and more housing markets across the country.
Okay, so another aspect has to do with that across the nation housing policies are feeling the crunch. So, do you believe that Congress should enact states and localities to tap into the SLRF dollars to help shore up affordable housing developments that are currently in the pipeline?
I see. I think you're referring to, because I had a hard time hearing, but I think you're referring to the money in the ARP that's gone to state and local governments and helping facilitate the direction of that funding to housing. I think that's what you were saying. And I think that absolutely. I mean, in fact, I think, I keep mentioning LIHTC, low-income housing tax credit. It's an incredibly effective way of increasing the supply of affordable rental housing in communities across the country. It's a tried and true program. We know how it works. And all we have to do is turn the dials here a little bit. And I think we can really juice that up and get a lot more supply into the housing market. It's not going to be next month or next quarter, but by this time next year, going into 2024, it'll be very significant. And taking some of that state and local funding, relief funding that was part of ARP that's sitting out there, and directing that, changing the rules a little bit to direct it towards juicing up LIHTC and other forms of funding for housing, I think would be highly effective.
Great. Well, thank you very much, Madam Chair. I yield back.
And
Thank you. The gentlewoman yields back.
And if I could just, I think there's an important point here on this. There are two things that really substantially contribute to housing prices in the United States. One is the state and local tax deduction. The other is the mortgage interest deduction, both of which tend to be fully capitalized into housing prices, particularly in supply.
Sir, you're out of order. I don't think anyone addressed a question to you, sir. The gentlewoman.
Thank you, Madam Chair. I yield back.
The gentlelady goes back. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Chairwoman, and thank you for this really critically important hearing. As you know, the pandemic has been, great for the richest Americans who have lined their pockets and doubled their wealth during the pandemic. As we all know, corporations have the nerve to blame inflation while consolidating their market power and raising the price of essential goods and services while working people foot the bill. For me, this is not inflation, it's extortion. Meanwhile, the same corporations who are gouging prices on consumers, on our neighbors, have been engaging in what we call the major stock buybacks. When corporations funnel their record earnings into stock buybacks, Madam Chair, that's money that they're not allocating towards capital investment, research, and development. So, Dr. Mahbood, just listening to your testimony has been really interesting to understand some of these trends. One of the things that I think we haven't looked at, and I would love for your opinion on, is what trends have we seen with regards to the major corporation and stock buybacks, particularly since the Trump tax cuts were enacted?
Thank you for that question. We're in a period where we're seeing record stock buybacks, and that's really important because that's money that's going out to shareholders, all while prices are going up. And these companies are not making productive investments in their firms, right? They're not investing in making the company work better. They're just grabbing as much profit as they can and sharing out shares to their shareholders. And tax policy is critical to this because if raising corporate tax rates or taxing excess profits is a real way to curb the amount of money that flows to shareholders and executives over productive investments in our economy.
Oh, thank you so much. And Dr. Zandi, are stock buybacks making our supply chains more resilient or bringing down prices for consumers in any way?
It's hard to connect the dots, I think, between stock repurchases and what's going on in supply chains and inflation.
But we have a record literally we have stock buybacks, right? A record number.
But that money goes to investors that reinvest. So I think that's a very tenuous kind of link, in my view. Yeah.
Okay. Today, one of the things I always say, we obviously didn't predict the pandemic would, be around the corner in 2019. But today we all know that the next crisis that will pose an existential threat to our economy is our planet. If our planet warms 2 degrees Celsius, the damage will be irreparable. Extreme weather events will be the new normal. Our communities would flood and our economy will be underwater. And these are real facts from many scientists across the world. So Dr. Zandi, we know extreme weather events like floods, wildfires, and droughts are occurring with alarming frequency due to climate change. Can you explain the impact climate change will have on our supply chains and on prices, for example, in the energy and food sectors?
Yeah, it already has, Congresswoman. I mean, for example, we talked about timber, lumber. One of the reasons for the severe problems we're having in that industry is because of the extraordinary weather events in the Pacific Northwest, particularly in British Columbia, where a lot of the timber is produced that goes into U.S. homes. So it's already having a major effect on, and it's affecting, timber supplies, where forests are growing, where they're not growing. It's a major adjustment that's adding to our costs and contributing to our global supply chain issues. So, it's not one of those things that matters a lot in any given year, but when we look back a decade from now, certainly.
Yeah, when you do nothing now, of course, the impact will be there later. I mean, look at all the lack of safety nets before the pandemic. We didn't have childcare. We didn't have a healthcare system that helped make sure that, we had pre-existing condition because of environmental racism. So I totally hear you, but I think, much of what's happening and the fact that we weren't able to save more lives during this pandemic is because of some of these broken systems and not thinking forward. Last year, a handful of dominant, shipping container firms reaped record profits while passing those costs directly onto the consumer, raising prices, y'all, by 1%, according to Kansas City Fed and the European Central Bank. Based on this evidence, I'm incredibly concerned that big corporations will simply look at the climate crisis the same way they viewed the pandemic, just another chance to make a quick buck. So, Dr. Mahbood, are we doing enough to address our supply chain fragility and exposure to climate risk? If not, what sorts of investments should our country, our federal government, be looking at?
No, that's absolutely critical because every new climate shock across the, a storm halfway across the world, when we have such a brittle supply chain, can bring the whole system crashing down. And so it's really critical that we check corporate power by using tax policy.
The
We make
gentlewoman's
critical
time has
investments.
expired.
Thank you, Madam Chair. I yield.
The gentlewoman from New York, Ms. Ocasio-Cortez, is now recognized for 5 minutes.
Great, thank you so much. Thank you, Madam Chair, and thank you to all of our witnesses for being here today. I want to explore a little bit about the role of corporate profiteering and its contributions to inflation, as we've kind of been discussing today, particularly in two areas, rent and groceries. Now, in terms of housing, big corporations are exacerbating what is already a major housing supply crisis in the United States. We have these major, often private equity-backed companies that are gobbling up homes in our housing market, which is already creating excess scarcity on top of the housing scarcity that already exists. And then by constricting that supply, we're also seeing a lot of these major, huge multi-billion-dollar companies then either flip those properties and just resell them at a higher rate due to that artificially inflated price, or they hold on and hoard this housing stock and rent out at exorbitant prices. Dr. Zandi, isn't it the case that the average American now has to compete with major companies like Invitation Homes, whose parent company is Blackstone, which is the largest private equity company in the world, when they're in the market for a home?
Yeah, I think obviously the institutional investors and mom and pop investors are a much larger, as I mentioned earlier, they're 1/4 of all home sales at the end of last year. So they are big players, and that's nationwide. So in some markets, if you go to an Atlanta or a Phoenix, or Boise, they're much higher than 1/3 to 40% of the market. So yeah, they're playing a very large role. They don't affect the amount of housing stock, right? I mean, the home is still there. It's changing. We're going from single family home ownership though to rental. So it's making it more difficult.
And available housing stock for purchase, I should clarify.
Yeah, exactly.
Yes.
Yeah, so it's definitely having an impact there. And that's why it's very critical in my view for lawmakers to really focus on the kinds of things to increase the supply that that this becomes less of an issue.
Thank you, Dr. Zandi. And it does seem as though, and so to clarify, the image that we have here is that you have a young couple, they tried to do the right thing. They were told that if you go to college, you'll get a good job. They graduate with hundreds of thousands of dollars or tens of thousands of dollars in student debt, but they work through it. Perhaps they have a young kid. They want to get a 2-3 bedroom home. And they're competing against the largest private equity firm in the world to purchase a home. In fact, companies like Blackstone, Zillow, and Bedrock are buying up to 15% of available homes. But what I find interesting here is that they're purchasing them in minority and low-income neighborhoods specifically, particularly in metro areas like New York, Atlanta, and Detroit. About 1 in every 7 homes in the United States is being bought by a corporation at an inflated price. Dr. Drummer, did you know, we're seeing here that even in communities like mine in Queens, renters are now facing drastic rent hikes as large as 30 to 50% up from what they were paying last year. Can you expand a little bit on how this concentration of corporate power and the skyrocketing costs of housing are being disproportionately felt in low-income, working class, Black, and Latino neighborhoods?
Thank you, Representative, for the great question. This is the market that we have created for housing in America. Right now, 6 million renter households are currently behind on rent. Again, as stated previously, that is double the pre-pandemic baseline. And 2/3 of these people are people of color. In 2021 alone, rents increased by at least 10% in 149 metropolitan areas. And what we're seeing around the country is a failure of policy and law to address the acute shortage of housing. If someone wants to make the case that this is just how markets are supposed to work, they can. My view is that our current housing crisis constitutes a serious, significant series of market failures that require robust policy response at the federal, state, and local level.
Thank you, Dr. Drummer. I have one more question as well. I want to explore a policy possibility with you. You know, there are a lot of ideas that are explored. The United States has very different housing policies than other countries and areas. What do you make of the idea of a public institution that purchased distressed real estate and financed its transfer to the social housing sector, such as cooperatives, community land trusts,
The
nonprofits,
gentleman's time
public
has
housing?
expired.
Yes, the Build Back Better bill actually has.
If the
Am I out of order?
gentleman's time has expired, if you'll just submit your answer, sir, for the record, that would be great. Thank you. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Chairwoman, and thanks to all the witnesses who joined us today to discuss the economic challenges our country faces. I represent a working class district. My constituents are the hardest hit by inflation and the hardest hit by interest rate hikes. We have to understand what's driving inflation in order to tackle it. And from your testimony, it sounds like it's corporate greed. Dr. Mahbood, in your testimony, you raised a pretty striking quote that I just have to revisit. Earlier this year, the CFO of Constellation Brands, a company that owns Modelo and Corona beers, and I admit I enjoy these frequently, and I quote him, "As you know, we have a consumer set that skews a bit more Hispanic than some of our competitors. And in times of economic downturn, if you will, or weakness, they tend to get hit a little harder and they recover a little bit slower. So we want to make sure that we're not leaving any pricing on the table. We want to take as much as we can." End of quote. I represent a Latino, largely immigrant district, and I can confirm that our communities were hit hard by the pandemic, but this is shocking. Our suffering is their excuse to raise prices. Can you talk about how corporate concentration is raising prices for some of the most basic goods that my constituents buy, from diapers to beer?
Thank you for that question. And that quote is really striking. I mean, the truth of the matter is we've heard over and over and over on earnings calls across a range of sectors that these big corporations simply have the power to raise prices, particularly when they have the cover of inflation to do so. And they're shameless about it, right? I mean, that quote is so bald-faced about exactly what it is that they're going to do, which is to exploit the pain of a community and pocket the profits as a result. And so we see that time and time again. We've seen that in Johnson & Johnson, with Chipotle, with McDonald's, I mean, I can go on and on with the number of companies that we've heard really taking a moment and of this moment to jack up prices and pocket the profits.
Thank you. Mr. Vahisen, big corporations and local businesses face similar challenges at the start of the pandemic, but market concentration allowed big businesses to reap record profits while local businesses struggled to recover. And as always, consumers pay the price with inflation. In your testimony, you laid out that our policy choices brought us here. I hope they can bring us out as well. Can we reverse decades of corporate concentration to avoid what we see happening today? What is the first step?
Thank you, Congressman. You're absolutely right. For 40 years, we've tolerated consolidation across the economy, and it was a policy choice. And just as we initiated certain pro-merger policy choices in the 1980s, we can undo those. And I think a good place to start is by reversing some of the mergers that have happened in recent years. I think meatpacking is a great industry to start with, since it's a driver of inflation, and we've seen extraordinary levels of concentration in that industry, driven in large measure by consolidation. So I think the Department of Justice and the Federal Trade Commission can actually unwind these mergers and create more competitive market conditions. And going forward, can strengthen anti-merger law to ensure that businesses grow through investment and hiring instead of by acquiring existing corporations and enhancing their pricing power.
Thank you for that. Mr. Drummer, from what we just discussed, it's clear that corporate concentration and price gouging directly contributes to increased prices of goods and services. Corporate greed should be addressed to mitigate inflation, but many policy experts are only talking about raising interest rates. Can you talk about in the next 50 seconds how raising interest rates hurts working class people?
That's an excellent question. Yes, if we use interest rates to curb inflation, what are we doing? We are literally driving down the demand for labor, which disproportionately affects the lowest income workers, which means that we are lowering their ability to bargain, right, and to demand higher wages, which means we're taking money out of their pocket in order to balance our economy. That is the most inequitable way to handle this crisis. We believe that the best way to address this affordability crisis is to turn our gaze away from inflation and focus on deep structural changes to rebalance our economy.
Thank you, sir. And Madam Chair, I yield back.
The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Well, good afternoon. I appreciate everyone being here. As I am batting here at the end, maybe I'll just talk about a constellation of things I've heard today and observations about some of this. Number one, I am frequently reminded of a famous economist, John Kenneth Galbraith, who famously retorted, when given the choice between changing one's mind and proving there is no need to do so, almost everyone gets started on the proof. This hearing is that proof. It is embarrassing to hear policymakers try to claim that it is anything but the policies that they have enacted that have led to this inflation. And frankly, much of the evidence, and I use evidence in quotation marks, by the way, that has been asserted in some of these testimonies isn't real evidence at all. I didn't see significant data about the surfeit of demand. I didn't see data about the wage gaps that existed 2 years ago that we overfilled with trillions of dollars of stimulus and transfer payments. No, I saw quotations from earnings conference calls about CEOs that mention the word price, and thus it must be corporate greed and profiteering and not real inflation. Secondarily, during the course of this entire hearing, I've been struck by the fact that no one here seems to understand that every price increase is not inflation. Inflation and price increases are different and can be rooted in different things. But I don't believe anyone here thinks that inflation doesn't exist, being separate from price increases. So I think some of you can argue short-term supply chain issues have led to certain price increases, but I don't think anyone can argue against the tidal wave of evidence that inflation also exists. I think third, it's almost embarrassing that we would sit here and say that inflation is not harming those at the lowest end of the income deciles, the people we are most here to help, but we have seen real wages decline month after month, purchasing power declining month after month because of these policies. I want to ensure that inflation does not continue to erode the purchasing power, especially of those that are least able to cope with it. Mr. Goodspeed, or Dr. Goodspeed, mentioned earlier that those in the higher income levels can cope better with inflation. They have many opportunities to substitute goods. They have many opportunities to move to lower cost locations. They have much exposure to inflation hedges. Those are not benefits afforded to those lower decile earners. I want to make sure that we tackle inflation in order to empower them. What I have heard, however, is that 40 years of failed policy has somehow led to a year of the highest inflation in those 40 years. So the mistakes of 40 years have somehow come together, and all of these corporations were sitting around biding their time for 39 and a half years, and by God, they saw this was the opportunity for them to dramatically raise prices. That was not the case. And Dr. Zandi also said that we can't directly tie the significant amount of stimulus that the federal government has undertaken during those periods because inflation didn't start, save it, for a couple of months after that. Certainly, he understands that it takes time from the moment federal legislation passes until those dollars are spent in the economy. What I have seen in table after table, chart after chart, data after data, is the tremendous growth in M2 and the tremendous acceleration in inflation on account of that, which has led to significant erosion in the purchasing power, especially those at the lower deciles. The reason Nobel Prize economists are not in here testifying to the contrary is because that is the case. Corporate profiteering, pandemic profiteering, cannot be the sole reason for this dramatic increase. And even Mr. Behessen, did I say that right? At one point said companies are beginning to take advantage of the inflationary environment to raise prices. Well, which is it? Did the inflationary environment pre-exist, corporations taking advantage of that to raise prices? It must have, for them to have used that, as you said, for cover to do so. This hearing is an embarrassment and a further proof of the great dichotomy between Washington, D.C. that wants to engage in political fallacy and Hoosiers back home that are picking up the tab for these failed policies. With that, I shall yield back.
Yields back the gentlewoman from Georgia, Ms. Williams, who is also the vice chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. And now we're in the home stretch with the last question of the day. Y'all, our economy is built on our infrastructure and supply chains. And in the decades before COVID, our infrastructure was slowly crumbling. Our ports, airports, roads, and bridges kept getting older, but year after year, infrastructure week remained an empty promise. Before President Biden, we didn't invest enough in the infrastructural modernizations that will help get products quickly to our people. At the same time, we didn't invest enough in making critical products here at home, even though we need semiconductors for everything, from credit cards to cars. We haven't produced enough critical products like this in the U.S. Before President Biden, we got by, but we didn't get ahead when it came to our infrastructure and supply chains. Whether it's an economic shock like a pandemic or an economic surge like we're seeing now, our infrastructure and supply chains have to be resilient over the long term if we want our economy to respond well to rapid change. Dr. Mahbood, how exactly does an economic surge stretch our infrastructure and supply chains? And what's the connection between the resilience of infrastructure and supply chains and the prices of everyday goods?
Thank you for this question, Congresswoman. I mean, corporations have the power to hike prices in a crisis like this because we spent a half a century allowing business executives and financiers to take control of every single piece of our supply chain, from shipping to manufacturing to trucking to rail. And so over the last 50 years, these companies have shaped our supply chains into the extremely brittle system that we have today. That means that when we experience shocks, whether that's a pandemic or a weather event halfway across the world, we're going to see bottlenecks and supply shortages. And big companies can use their dominance in markets to hike up prices because consumers don't know how much of that is the rise in input costs and how much of that is just them padding their profits. That's particularly the case when they have the cover of inflation.
So under President Biden, GDP grew nearly 6% in 2021, and the demand for goods has boomed as consumption patterns have changed. Democrats know that we can't build the economy of the future with the infrastructure of the past. That's why we invested in long-term success with the bipartisan infrastructure law. Dr. Mahbood, in what ways will the long overdue infrastructure investments from the bipartisan infrastructure law address the supply side vulnerabilities currently impacting prices while fostering the continued record-breaking economic growth that we've seen under President Biden?
Shoring up our infrastructure and key nodes of our supply chain is absolutely critical to making sure that we have functioning supply chains that can deliver goods on time and that doesn't allow these big corporations to, really take advantage of the situation. Furthermore, this bill has critical investments in childcare and other aspects of our economy that have been putting strain on family budgets for decades. So these investments are long overdue. And frankly, with the ARP, I think we really saw how effective these investments are in making sure that people can live a good life in this country.
So that led me to the next part of my question. Under President Biden's leadership, we boosted our economy from the brink with the American Rescue Plan and invested in our long-term success with the bipartisan infrastructure law. But we know that we have more work to do. Reducing inflation means advancing our global competitiveness and investing in housing, childcare, paid leave, healthcare, and more so that we can lower costs for working families. Dr. Mahmood, can you expand on how making these investments and realizing President Biden's full vision for building a better America reduce rising costs that are impacting everyday people?
Absolutely. I mean, people are feeling this, right? They're feeling the pressure of rising prices, but they're also feeling all of the issues that you just talked about, in rents going up, childcare being expensive and hard to get access to, healthcare taking a huge toll. And so really tackling both sides of that equation and making sure that people have the means to participate in the labor market and continue this, historic recovery is absolutely critical.
Thank you so much, Dr. Mahmood. And Madam Chair, I yield back the balance of my time.
The gentlelady yields back. I'd like to thank all our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is now adjourned. We thank everyone.